Morning, everybody. Howdy ho, neighborinos. How we doing today? I'm a couple minutes early. Hey, good morning, Ron. Better Dad, good to have you. Better Dad, that document is kind of for you in there. I took a quick glance at some of your pictures. Management, your entries are great. Management's the tough part. I noticed that you wrote hope on one of your trades, so we'll go back and we'll talk about all of it. You're looking at it now. I think it's one of the things that, we go through all the very basics, the best of the best, the most basic forms of doing things in this room. But there's so much room beyond that. There's so much growth that happens beyond that. And every now and then I drop things in, but you're getting to that point to where you understand the basics, and now you're starting to expand a little bit. So when you get to that point, some people, not all people, but some people let their chart reads supersede their rules. They let their chart reads dictate instead of just allowing the rules to be met. One of the reasons why I think black and white is so effective in day trading, and for those of us that aren't really black and white, it's one of the reasons that there's struggles every now and then. So do you? Well, from the outside looking in, Better Dad, you've put yourself in a great position. Now you have the burden of being smart. And it's funny because it really is a burden. The better you guys get at reading your indicators, the more you're going to see. And the more you see, the more likely you are to embrace the idea that you're human and trade your opinions or your thoughts. And that's where words like, whoops, man. That's where words like it should, it will, it has to. That's where those things work their way in. And those are the words that kill day traders. My brother and I joke about it every day. The difference between trading your rules and trading your opinions is a very, very fine line, which is why rules have to be so clearly defined. Anyway, getting ahead of myself. Did news do anything this morning? It didn't look like it did a whole lot to the NASDAQ. Looks like it bumped it right into a little bit of a tailspin. But we knew about it. We knew that at 8:30 a.m., nothing on the NASDAQ. Yeah, I took a picture. I was laughing. That was my exit because it was right before news. Perfect trend trade, odds favorable, potential to break, everything down, first target. And I was like, oh my gosh, news is about to print. So I took my exit, and thank goodness I did. They went right back to their range, didn't they? I knew that news could create a spike, could make the market change directions. Hey, good morning, Cav. Good to see you. So every morning I come to forexfactory.com. I'm looking at those releases, and I'm just saying to myself, these are the things that could make it move. And guys, at 10 a.m., there's medium impact news. This is existing home sales. And you're like, well, Mark, how could that possibly affect the market? I don't know, but it's medium impact, which means that it could. So you have to make the decision whether or not you want to trade into medium impact news. For me, high impact, the red boxes, is 100% no fly zone. Medium impact, I might just protect a little more. If I'm already up 10 points in a trade, I'll go break even and risk it sometimes. That's just me. And then at 10:40, President Trump speaks. Don't know what he's going to say, what he's going to talk about, but there's people that love to react. So check news every morning is what I do. And then I drag you guys over to the Nexgen page where I remind you that everything that you need to be successful with the software is going to be put at your feet today. All the answers, I won't say all the answers, 99% of the answers to any question you could come up with, guys, you're going to find them in the trading guide or the software guide. The trading guide specifically is where we talk about where you'll get the rules. What are the indicators you're looking at? How do I define the rules? How do I manage it? What's a prop firm? There's that market flow chart I keep seeing. HVA momentum trades, the future trades for you. Market flow techniques, swing trading, crypto. There's your economic calendar, screen capture tool. I mean, everything, guys. We go to great lengths to not keep secrets from you. But in the frequently asked questions, there's one thing specifically that I want you to focus on as a brand new user, and that's what we call the high probability trade. And this is a trade where each indicator on every chart agrees with the rules for the trade. Triggers are their strongest. There's no terminations, nothing between you and your targets. This high probability trend trade is the first trade that I teach. It's the same trade that I go over every morning for an hour. We take this trade. You're going to know by the end of this first hour what the rules are, how to identify them, what they mean to you, how to study them, where they're found. I mean, everything is going to be put right in front of you. And once you figure this trade out, once you learn this very basic trade, it opens the door for the next trade. And I wanted to make that stop here today. Your high probability trend trade isn't your only trade. Your high probability trend trade is a trade that typically wins 70 to 80% of the time when you follow the rules. The high probability trend trade is the trade that teaches you to read your indicators, that puts you in a position where you can look at your charts and you can say, I have this advantage or I'm lacking this advantage. And that opens the door not only for being able to manage differently, more assertively, more aggressively, more conservatively based on your ability to read the charts, but it opens the door for the rest of the trades. And the next one is going to be what we call a medium probability trade. And this is a trade where most of your indicators will line up for the trade. However, a small issue exists. You're going to rely on your ability to read charts to identify that issue so that you can say to yourself, things aren't perfect here, but they're pretty close. I'll still take the trade, but I will manage it assertively. If there's trouble in your way, your chart reading is going to pick it out for you. You might take quick profits. You might get to break even quickly because it's not the highest probability trade. And that's what the majority of your trades will be. So I'm going to encourage you guys, learn to read your charts. Learn to recognize the rules for the high probability trade. Learn to identify the advantages that come from the rules being met, because this high probability trend trade, the whole purpose is to teach you to read your charts. Good morning, Jeffrey Dean. And you'll realize quickly that 90% of your day is typically spent reading your indicators, waiting for advantages. 10% of your day is actively trading. But if you embrace the read before you chase the profits, you're going to find yourself in a position where you understand where the market is likely to continue just by reading your indicators. You're going to use that for an entry for these trend trades. You're going to understand where the market is likely to go, and this is going to help you with profit taking. You'll also understand where the market is likely to stop. And I believe this is the most effective tool that we have, is understanding right where the market trend may end, right where it may bounce, right where fights can happen. And you'll be able to make the choice to not trade into them. So this high probability trend trade is a 3-rule scenario. That's it. There's only 3 rules to the trade. There's no reason to make it more difficult than that. When a rule is true, when it's met, you have an advantage. So rule number 1, strong triggers, will give you the advantage of momentum. And when we talk about the advantage of momentum, we're talking about a market where the odds are favorable for it to continue in the direction of the trend. We're talking about advantage so impactful that it can help break key Fibonacci areas. And that momentum advantage will even help cover up a lot of the mistakes that we tend to make, or maybe justify some of the chances that you choose to take as a trader. So momentum really is rule number 1 for a reason. We're going to talk about how to identify it, where to identify it, and what it means to you over and over. And then rule number 2 says no termination conditions. Termination conditions are those likely to stop the market areas. If there's none in the way, you're going to have room to your profit targets. We're just going to call it a clear path. And what's amazing is that you'll be able to identify these areas. And again, you'll be able to make the choice to trade away from them rather than directly into them. and it'll increase the likelihood of success. And then finally, rule number 3 is specific to a trend trade, and it defines that point where the market is most likely to bounce and continue in the direction of momentum and clear path. And rule number 3 is just an entry rule. So those first 2 rules, momentum and path, guys, this is your core, momentum and path. Once you can identify these 2, you have everything that you need to begin to grow outside of that high probability trend trade. You have everything that you need to create a plan or embrace the pre-existing plan that has been proven to win more than it loses. So momentum and path are your focus. Give it 5 days in some intense study. And by the end of that 5 days, you'll be ready to open doors for more. These 3 rules come to be on only 2 charts. Nexgen uses 2 charts for the brand new user for the high probability trend trade because that's all it takes. That's all you need. There's a large chart, and the large chart defines direction, it defines momentum, and it defines areas. And it's a very broad stroke, slow moving chart. It's difficult to see change. It's kind of a reflection of the overall opinion of what the market wants to have happen. Your first 2 rules, the advantage of momentum, the advantage of a clear path, these are met on the large chart. 66% of your advantages must be true before you go to a smaller chart. And the smaller chart's just a refinement chart. It takes that very broad stroke of a brush and it refines it down to see the smaller movements. And that's how you're going to pinpoint your entry. It's the best of the best that reduces risk, that increases profit potential. And that's where rule number 3 happens. But rule number 3 should only come into play when those first 2 core advantages are on the table, because these are the 2 that help create winners. This is the one that helps reduce risk. We use these 2 charts. They are very much a reflection of who you're trading with or who you're trading against. Large chart defines direction. Hey, good morning, Alex. It defines momentum. It defines areas. The large chart is the large crowd, the men and women with enough money and influence to establish a trend, to create that momentum. And these large crowd people, these are the folks that are making decisions right at key Fibonacci areas. They're the ones that are entering and exiting and fighting one another right at those key Fibonacci areas that you know about long before you get to them. So allowing the large crowd to lead the way typically ends up at the best results. Your small chart is the small crowd who still have a lot of money, a lot of influence, but they fight. If the large crowd says up, these guys say down, and vice versa, and they have just enough influence to create these little pushes, these little retracements counter to everything that the large crowd wants. You won't see them in the large crowd's bar. It's a big slow moving bar. But on the small chart, you'll be able to see that little bit of a fight. You'll be able to use rule number 3 to pinpoint where that small crowd is most likely to lose their fight. And the great thing is they typically lose their fight 70 to 80% of the time. So when you're trading with the large crowd, when you're using rule number 3 to pinpoint where the small crowd is most likely to fail, you're putting yourself in a position to have the potential to win up to 70 to 80% of the time. The opposite of how often they fail. So we're going to learn the trigger line and Fibonacci rules for when it's okay to trade. That's my job every morning, is to teach you guys what the indicators look like and how to use them to identify advantages. All of you have the ability to simulate, to practice, to take pictures, to annotate charts, to drop them in the room and to get a private session with me, because it really is. It's a private session. If you drop a picture in the room, we're going to talk about the advantages that you see. We're going to talk about your entries and your exits. So every time you guys print in or post in the room, the one thing that I ask you to do, where is my annotation chart? Uh-oh. I've lost my annotation chart. Well, never mind. Don't do it. The one thing that I ask you guys to do for me is tell me why. Anytime you post a picture in my room, tell me why you took the trade. Tell me what you saw. There we go. That made you want to get into that trade. Tell me what your chart read was. Describe the momentum, describe the path. And this is really important. Show me your entry, but show me your exit. Because every time I go back to your charts, guys, I'm going to talk about momentum, and we're going to make sure that you're reading accurately. And we're going to talk about whether or not you had a clear path to make sure you understand when there's nothing in the way or when it's only potential. And we're going to look at your entries and make sure that you have the least amount of risk, or at least make sure that you understand where your risk needed to be. And if you show me trades to completion, we can talk about your management. We can talk about whether you jumped out too soon or you held too long. And every time you post in my room, guys, it's a private session. It's you and I focused on what you're doing, looking for patterns, identifying challenges, letting you know what you did right or wrong. That's what you need to grow with the software. So that's the first step in becoming a confident trader ASAP. The people that post the most, guys, they typically get to where they want to be the fastest. We're also going to simplify. I try not to make things too difficult. I try to break everything down to the least common denominator. I'm going to hand you a plan this morning that is 2 trades deep. It's a high probability trend trade, what we're going to talk about for the next 40 minutes. And it's also a medium probability trade. And the medium probability trade will probably be the one that you take more often, but it requires a little higher level of chart read. You need to learn what looks you're going to commit to. And when I say that, you need to learn what it looks like to have your advantages in play. You need to be able to recognize momentum and path and define an entry. And it's just a pattern. And it took me a while to realize this, is your high probability trend trade is nothing more than a pattern. It's a pattern that repeats itself. Yesterday, if you were watching the classroom on YouTube or you were in this classroom, you saw 3 different markets have a high probability trend trade at the exact same time. 3 different markets producing the exact same pattern with the exact same results. So what we're doing is we're focusing on that pattern because it's been proven to win more than it loses. And that's what you have to learn to recognize. And that's where the second piece of becoming a confident trader, ASAFP, comes in, guys. Use the spreadsheet that Nexgen gave you. Man, look at this. This is an old one. I don't know where this came from. My computer is doing weird things. So there's 4 tabs on this spreadsheet, guys. There's the trade tracking tab. And this is where you're going to put every trade. You're going to say, this is what I did, this is what I saw, this is what happened. And most importantly, this is the feedback that I received in class. Sometimes your feedback will be, this is perfect. Sometimes it'll be, hey, this is the rule you've broken. Sometimes you'll start to see it over and over. I keep breaking this rule. I keep breaking this rule. And when I notice this, 3 or 4 pictures deep in what you present, we'll really start working together to fix that problem. We'll really start working together to give you a plan to stop trading into those termination conditions. So you're going to see the things that are helping, the things that are hurting. Use that trade tracking. Go back and study it each morning. Look at what you did yesterday and say, wow, this has been great for my success. Or, man, this is kind of messing up what I'm doing. Let me avoid this one and let me focus on the things that are making it great. There's the basic rules section, and I don't know why my spreadsheet regressed, but I've got strong triggers and weak triggers. And I've got a clear path and terminations. I've got the rules met and the rules not met here. I'm going to give you a sheet to be able to look at this, to be able to study this, to be able to add to this. And then I've even got some of the high probability trend trade entries made their way back in. There is the client trade section. Man, and I'm missing a lot of them. This went back like 2 months. And the client trade section is all of the entries, all of the exits, management, entries, a little bit on NASDAQ, patterns that repeat themselves. All it is a study guide to go back and see this over and over, these patterns that repeat themselves, so you can commit them to memory, so you can get to where you want to be. I need to find the spreadsheet that I dropped in the room yesterday and overwrite this one because we're missing a lot of great stuff. And then finally, this is where you're going to build your plan. This is where you're going to take those pictures, to drop them into the spreadsheet to say, this is my pattern, this is how I'm going to manage. And it's going to give you the ability to just recognize these things that are repeating themselves over and over. And guys, the more pictures you take, the quicker you get to where you want to be. So I'm going to close that one out, and we're gonna get to work. We're going to start learning this high probability trade. We're going to start looking at these 3 rules. I want to try this again and see if it brings up the right one. It did. This one brought up the right one. I don't know why the old one didn't, but that's cool. Good deal. So we're going to break this down, and we're going to look at each rule individually. We're going to talk about how to identify it. So not only will you have the visual, but you'll have like a little definition that you can type off to the side to make sure that the visual is true. We're going to talk about what it means to you in terms of the advantage. I'm going to give you something that you can study these. I'm giving you the spreadsheet. I'll drop it in right now that I know it's the right one. So now you're going to have a place to study it. By the end of this first hour, you'll have everything that you need to be successful. Let me close that out. And hopefully, sorry, my PowerPoint changed a little bit, but we're good. My apologies for sounding confused. Here we go. We're going to talk about the 3 rules, guys. Oops. Let me start my slideshow back up. I swear I'm not as silly as I sound right now. Has anyone ever had their computer go back 3 months? It's kind of weird. And now it's back to normal. Each rule will be broken down, but we're going to start with defining trend, because rule number 1 says that you must have strong triggers. And I'm going to give you guys this little trick, because the only way you can have strong triggers is if you're trading with the trend. If the background on your large chart is green, the market's going up. If it's red, it's going down. The trend is your friend is a cliche that's been used in trading for probably 100 years, and it's such a true thing. So when we talk about the large chart, oh, you know what I missed? Guys, I'm going to back up. Forgive me. Let's identify the pieces that we're using. Let's talk about what we're looking at. And I apologize for the backup here. But this is important. You need to know the pieces that you're working with. So both charts, large and small, will have trigger lines. There are small triggers, which are the solid lines. They're a fast-moving average, but that's not important. You just need to know that when you have 2 solid lines, they create the small triggers. If you have 2 dashed lines, and you will on every chart, these dashed lines are the large triggers, and they're a slow-moving average. And it doesn't really matter that they're a slow-moving average for the high probability trend trade. What's important is that you understand that, let me get my pew-pew, these are small and these are large. And even when they're red, these are small. These are large. And once again, green is up and red is down. And you're going to see these on your small chart and your large chart. If you build more charts, you're going to see these on those charts. You're going to use trigger lines to define momentum in the market. You're going to use trigger lines to identify termination conditions. You're going to use trigger lines to pinpoint entries. So know the difference between small and large, and then don't overthink it beyond that. Both charts will have areas. Areas have names. Areas do not have ranks in terms of importance. So there are divergence high lines, which is, this is going to print if there's a loss of momentum. If the sellers steal momentum from the buyers right at that price, you'll see a pink line and a negative number print. If the buyers steal the momentum from the sellers right at this precise location, you'll see a negative number and a cyan line print. So divergence is a loss of momentum. You have highs and lows. There is Fibonacci resistance, which is just a red line that runs horizontally. There's Fibonacci support. It's a blue line that runs horizontally. There are yellow 1-to-1s, and these are yellow dots that run horizontally. And then you have a midband, and this is the only one that's got a little wiggle in its game because the midband is a moving average. But once again, we use colors to help a little bit. If everything is above a midband, the midband's green, up, right? If everything is below, it's magenta, down. So support, potentially resistance. On your large chart, these are the areas where the large crowd makes decisions. These are the areas that can define your termination conditions. On a small chart, we use areas a little differently. You're going to use areas for entry. So make sure that you know the names. Don't worry about the whys. Just be able to identify them. So large chart must have strong triggers. This is rule number 1. You got a little preview of that. The only way to have strong triggers is to trade with the trend. So in an uptrend, in order to have strong triggers, everything's got to be green. Both large and small and the background are green. In the downtrend, both large and small must be red. So we're just going to let the colors match, guys. This really becomes a little bit of a safeguard for you. Strong triggers means essentially that there's a separation between the small and large, that the smalls break away from and above the large in an uptrend, that the smalls break away from and below the large in a downtrend. And I want you to picture scissors that have opened up and are ready to cut. When the scissors are open, when the space is there, when the colors match, the odds are favorable for the market to continue in the direction of the trend. Odds favorable momentum is our battle cry in this room because odds favorable momentum is rule number 1 being met. Strong triggers means the odds are favorable for the market to continue. Odds favorable momentum pushes a market. It can break areas. It can cover mistakes. Odds favorable momentum is where I'm pinpointing my entries. On the large chart, I don't see the fluctuations. They just look like tails. You're going to be able to use these tails to go back and study them, to put the 3 pieces together to study this trade and recognize the pattern. So anytime you see odds favorable momentum, and there was a tail scrolling back historically, doing your study, know that these were potential entries. But momentum is not a forever advantage, guys. The market is finicky. It goes up, it goes down, it pushes hard, and then it slows down. And when your small triggers work their way inside of the large triggers, this is a visual that the trend is weakening. This is the visual that the trigger lines are no longer strong. These weak triggers let me know that anything can happen. So if we're just doing association, word association, anytime I see strong triggers, I have to believe that that's a market likely to push in the direction of the trend. I have to know that that's what it takes to break areas. This strength should just create confidence in you. And then when you see weak triggers, anything can happen up or down, and you have to believe that that's the scenario. Weakness doesn't push a market. Weakness makes it harder to break key Fibonacci areas. When I have weakness, the market may retrace from the middle of nowhere. Key Fibonacci areas are more likely to hold. So just use a little association. Strength versus weakness. Odds favorable versus anything can happen. And let's go, and my Ninja Trader crashed, so we're just going to go on. Is everybody good? It's usually a pretty basic concept. Momentum is the one that people don't struggle with. Momentum is really an opportunity to have a market that's pushing. Once I get my Ninja Trader back up, we'll go look at a real world example. The second rule, whoops. Do not want to open that one first. I'm going to open up my crude oil for you guys real quick. Get my connection going. My computer is messing with me today. So crude oil's loading up. Rule number 2 says termination conditions false. What does that mean? Well, it means that there's none of those areas that could stop the market in the way. It means that I'm going to have room to my profit targets, and it's the second piece of that core. It's going to mean that I have a clear path. A termination condition, here's from the user guide. It's a Fibonacci-based indicator that may reverse the market based on a comparison of the area and the trigger lines. You know what? It's a horizontal line on your large chart, guys. It's a horizontal line. It's a divergence high or divergence low. It's Fibonacci support. It's Fibonacci resistance. Hell, it could even be one-to-ones. But these lines are where the large crowd are making decisions. These lines are where buyers are buying and sellers are selling, and this is where fights are happening, where reversals have the potential to show up. So we're just going to learn the names, and I want you guys to write down on a piece of paper, this is where the large crowd makes decisions. Because what it does is it sets you up to really understand how to define it. Because if I need the large crowd making decisions to identify it, I need price to get to resistance. Means these dynamic Renko bars get to resistance. And guys, once price gets there, the decision making starts. And the decision could be that it's going to break, that it's going to reverse, that it's going to bounce, that they're going to fight. You'll never know what the decision's going to be, but your trigger lines will tell the story. So when price reaches resistance, we're done with price, we go to the trigger lines. If the trigger lines are below resistance, this is a termination condition. This is rule number 2 not met. This is that area where I don't know what the reaction is going to be, but my rules say don't trade into it. Don't take a trade into an area that's likely to stop the market. Because if you go and take 10,000 pictures of price reaching resistance when the triggers are below, more often than not, it's going to create a loser if you decide to trade into that line. So price reaches resistance, I want you to say, where are my triggers? And if my triggers are below, no trades into the area. It could bounce, it could break, it could fight, or it could reverse completely. And that means that it's a strong top. And guys, when the decisions made at a key area are so impactful that they reverse the market, we're going to designate that a strong top. And a strong top is the precursor to the highest probability trend trade short you could ever take. And a strong top is rule number 1 for at least 3 trades that I have rattling around in my brain right now. So from a strong top, look at the momentum, and the market is screaming down. Maybe you found an opportunity in there and everything's going, and then you reach Fibonacci support. And once you reach Fibonacci support, we're asking, where are my triggers? That's it. That's all you have to do. The triggers tell the story. If the triggers remain above support, it's a termination condition. It could create an untradeable bounce. There could be a fight between buyers and sellers. It could break, or it could reverse the market completely, making it a strong bottom. And a strong bottom, while it's not a rule for the high probability trend trade, it puts you in the highest probability trend trade you could ever take. So the simple thing to say is if price reaches an area and the triggers don't break, rule number 2 is not met, no trades into the area. Wait for the reaction. Is everybody good with that? Let me find a large chart here. Let's see if there's any truth to it. Resistance, triggers don't break. Resistance to support. From support, off resistance. Oh my gosh. Right off resistance, right off support. Guys, it's very possible that people that aren't us know exactly where these levels are. And currently, we have odds favorable momentum, and we have what's called the potential to break. And that's what it looks like when areas break, because they break all the time, guys. This is the life cycle of an area breaking. Number 1 is price reaches the area, the triggers remain below, it's a termination condition. Wait and see what the reaction is, guys. This is the pain in the ass look, because it means you're not taking a trade. If your small triggers and your large triggers, both lines of each, get north of resistance, resistance is now broken. It's behaving as support. The path is clear, and the path remains clear until you reach the next line. And then we go back to number 1. Guys, every line will be a termination condition. Whether it's a fraction or a second or for 10 minutes, you'll never know. So no trades, look for an entry. And guys, this is your most basic approach. Once you understand it, it opens the door for the second one here. The second, number 2, This is the potential to break because of momentum. We call this a 50-50 look. And there's a trade that revolves around this look that's going to be in the plan that I give you. So when your small triggers absolutely smash through an area 3 to 4 points, but the large triggers are lagging behind, they haven't made it above resistance yet, as long as you have odds favorable momentum, guys, this is where you can take a trade. You can take this medium probability scenario because it's not a clear path, but you have to manage it assertively. So again, you're going to have no trade, look for an entry, let me make sure it's perfect because it's not high probability. And you're going to get that both directions. No trade, potential to break, trade away because it's a clear path until I reach the next area. And I think there was a lot of examples going on in crude there. Weakness says no longs and it saves your bacon. Potential to break created a pretty big retracement that might have taken you out of the market. Potential to break, but did not. And guys, we are currently in a potential to break with all of that momentum. Look, does that make sense to everybody? Small triggers have smashed through. Large triggers have not yet cleared 1-to-1s or a fib. Guys, the potential is there, but it doesn't guarantee a break. And the only reason I want you to say it's potential, it's not broken, is because it's going to put your management hat on. It's going to force you into a position where you make sure that your smaller, faster chart is giving you everything that you need as you look for that pullback to an area of resistance inside of triggers. So that's it. That's your black and white. But there's going to be times, guys, when your path isn't clear because the areas are stacked. And this is where that little devil on your shoulder is going to tell you to take the trade anyway, because what if? What if it breaks? What if it runs without you? What if you don't make money in this little 5-minute increment of the day? Guys, this is 90% of your day of doing nothing. This is when the profitable traders and the traders that are struggling get separated from the herd, separated from one another. Doing nothing when the path isn't clear is one of the greatest advantages you can give yourself. And this is 90% of your day. If you trade, if you sit in front of your computer for 6 hours today, you are likely to be active 36 minutes of that 6 hours. But it's okay because the futures markets, they trade billions, actually every hour. Trillions is exchanged in the futures market daily. Lonnie, no sir. 50-50 is identified on the 13-2 chart because the 13-2 chart identifies the momentum that we need, and the 13-2 will identify the trigger lines, letting us know that it's not broken yet. And Lonnie, you'll use your entry chart to make sure that you have the best of the best look. And the plan, and let me show you, so if the path isn't clear, this is why I think learning advantages is so key. If you say, oh my gosh, that's a 50-50, that's not a clear path, do you see how easy it is to focus on what you shouldn't sacrifice? If I don't have a clear path, I don't want to give up momentum. I want to make sure that my entry area is perfect because I'm already missing 33% of the good stuff. Does that make sense, Lonnie? So we're going to be able to use that smaller, faster chart to make sure that we're not starting to lose momentum. We know we have it on the large chart, but the small chart gives us the heads up a little sooner. And we're going to make sure that we can take a lower risk entry because it is only medium probability. And sometimes you'll get no trade, and then you're like, oh, cool, I have the potential, and then it hits the next one. Well, I have the potential, and damn it hits the next one, guys. It's okay to not be in every move. Because if you can capture $400 trading away from Fibonacci areas and capturing profits before you reach the next one, $400 a day is a 6-figure income based on your trading. And then Lonnie, here's a good example of how the small chart will tell you that potential is going away. So in the one chart on the big chart, you've got momentum and the potential to break, and that market is screaming. On your small chart, divergence is a loss of momentum. So Lonnie, loss of momentum, loss of momentum, loss of momentum. we're seeing change on the small chart that says this area is less likely to break. And that's the only termination condition on a large chart. And when you're making decisions about 50-50s, this divergence will be one of the biggest reasons that new users choose not to take that trade, because 3 divergences can terminate the trend. And if it's a high probability scenario, guys, this is the only termination that I respect. If it's a medium probability scenario, I'll let even 1 divergence talk me out of it. But this is going to show you the change that you can't quite see happening on the large chart. So that's the only time, if I have momentum, if I have a clear path, that I'll choose not to take the trade. Is everybody good? That's terminations. How easy is that? Price reaches the area, none of the triggers break, sit on your hands. Let's see if we can find an instance where those 3 divergences came to be. There we go. And that was in the middle of the morning. But if I circle these 3 divergences right in the same price range, do you see how the large chart had odds favorable momentum? Right? The large chart is screaming to the upside. And it doesn't quite have a clear path. And 3 divergences push it lower before it finally heads up, which means it would have been pretty easy to take a loser there. But 3 divergences said, hey, get paid, get out. You're all right. There's more coming. And that's kind of what we do is we believe with a little bit of study that there's more coming. We believe with a little bit of time in the market that the next trade will present itself, which makes it easier for you guys to do nothing when the rules aren't met. So if I have momentum on the large chart, if my path is clear on the large chart, it's just a flow chart, if then I'm going to use a limit order to buy or sell a pullback at an area inside of triggers. That's rule number 3. The accuracy will have you waiting for the market to come to you. You're going to buy or sell a pullback, that fight by the small crowd, that retracement that goes against everything the large chart says. You're going to do it in an area because areas are bouncy. The same way they can stop a forward trend, they can stop a trend, they can stop that retracement and create a bounce in the direction of the trend. But if this is the most important piece of the puzzle, you want that area to be inside of triggers, because triggers are going to define where the retracement is most likely to occur. So when everything is screaming up, when the small crowd starts to fight, large triggers define where the retracement may go. And price returns to the large triggers on the small chart, and price returns to the large triggers on the large chart. So since it's 2 different time frames, 2 different charts, we just put the large triggers from each on your entry chart, and from the top line to the bottom line, it defines where the retracement is most likely to occur. This is important. If you want a much smaller box, a much smaller range, insist on favorable large triggers. Because favorable large triggers mean that the large and the synthetic are one on top of the other. The large chart triggers, the large chart large and the small chart large are in the exact same location. So it gives you a very concise point where price is likely to retrace. When you put a fib, a midband, or a yellow 1-to-1 inside of those triggers, you're giving the market something to bounce off of, guys. And favorable large triggers creates what we call the smallest window of opportunity. The smallest area where the small crowd is likely to fail, the smallest area, the most accurate way to take a trade. So we're going to define it real quick. We're going to go through, and in this particular scenario, the large chart has odds favorable momentum to the upside. The large chart has nothing in the way, so no termination conditions. And the large chart is done. The large chart has given us everything that we need. So we're going to turn our attention to the small chart. We're going to use that refinement process and pinpoint our entry. So the first thing that I need, when everything is screaming up on every chart, and this sounds counterintuitive, I want a reversal bar. I want the small chart to start pushing down. I want the small chart, the small crowd, to start fighting. So once I get the reversal bar, I'm going to identify where the retracement is most likely to go. And price tends to return to the large triggers. Guys, I have large triggers and synthetic triggers on my entry chart. From the highest line of the large triggers to the lowest line of the large triggers. This is where the market is most likely to retrace. Your trigger lines are not your entry. The tighter they are, one on top of each other, the smaller this box becomes. So this white box represents where this retracement could occur, where it could go. The very bottom of this box, I have to say to myself, it could show up all the way down here. But we can refine this a lot by using areas inside of triggers. The areas inside of triggers are what we anticipate to create a bounce. The areas inside of triggers are where the small crowd are most likely to fail. And areas can be fibs, midbands, or yellow 1-to-1s. Guys, areas cannot be divergence lines. Fibs, midbands, yellow 1-to-1s. Inside of triggers, all caps. So this box, much smaller than the previous, this shows me where the market is most likely to bounce in the direction of the trend from the large chart. Remember, my large chart is going up with ferocity and nothing in the way. This is where it's most likely to bounce and continue with that trend. You're going to develop the trust to put a limit order 2 ticks above that highest point of support, because with all that momentum on the large chart, we don't want to miss this one. And that's all you can do. All you can do is make sure that you have odds favorable momentum. All you can do is make sure there's a clear path. All you can do is define your entry and wait for it with an order, and then you're done. It's out of your hands. You're either going to get an entry or you're not. But if you get an entry, if that retracement does come back to the large triggers, if it does go to that area inside of triggers, guys, you're in a long position. And you're in a long position with the advantage of a market where the odds are favorable for it to continue up. And you're in a long position where there is absolutely nothing on that bigger chart to create a bounce against your trade. And you're in a long position having entered precisely where the trend was most likely to continue. And guys, this is your high probability trend trade. This is your bread and butter. This is your core. This is your foundation. This isn't your get rich trade, guys. This is the trade that teaches you to recognize your get rich trade. This is the trade that teaches you to manage more effectively. This is the trade that teaches you to recognize advantages, to recognize patterns, and eventually turn it into your own trading plan. So we're going to go through identifying where the market is most likely to continue one more time. Is everybody good? Momentum, path, and entry. Momentum and path are established on the large chart. You're going to wait for the reversal bar. The reversal bar is not your entry, but rather it's the beginning of the fight. Once you get your reversal bar, you're going to be able to identify where the market is most likely to continue. And that likely to continue area is going to be areas, or where it's most likely to retrace, excuse me. And then you're going to define through areas where the market is most likely to bounce and continue. And guys, that's it. Same thing over and over. Over and over. Define where the market is most likely to continue. And you'll recognize that anything outside of those trigger lines, anything past the areas inside of triggers, this isn't a part of your window. This isn't a part of the equation, guys. If the market makes it all the way down here, you've blown through all the good stuff. You've blown through the retracement zone. You've blown through the areas most likely to stop it. And guys, this is honestly what we call where the market should not go. And once you get down here, it's no man's land. You don't know if, when, or where that market's going to continue up. Oh my gosh, where? Sorry guys, we are having technical difficulties on my end. There we go. Short trade. In a short trade, everything says down. The path is clear. You wait for the reversal bar. It signals the beginning of the pullback. It's not your entry. You define where the retracement is most likely to go. Triggers are not your entry. You define your window by the areas inside of triggers. Drop that limit order 2 ticks below, and you know that anything on the wrong side of the triggers, anything beyond the triggers, anything above them, past the areas most likely to create a bounce, guys, you don't know if, when, or where. that market's going to turn and continue down, this is where the market should not go. So by defining where the market is most likely to continue, you have defined where the market should not go. And you're going to use this for stop placement, guys. Your understanding of great entries is going to be the first step in your management, because your initial stop will be placed 4 to 5 ticks beyond the trigger lines. I'm going to give you a plan with this management plan in it. And guys, you're going to say, they're going to have to come get me. They're going to have to break through everything if they want my money, because if they can't, it's more likely to go down, guys. And this is your pattern, and it's so important that you just learn the basics, then piece them together for a trade. Be able to identify momentum and understand that's only one of 3. And then be able to identify path. And before you ever get off that large chart, you can have 66% of the goodness in play. And it's trading all the way up here when it's time to look for an entry, guys. That's why we wait for the reversal bar. And it takes that short little distance to trouble and triples it. Because if you wait for the pullback to the area inside of triggers, you're going to have the absolute furthest distance to get to your profit target. You're going to have the least amount of risk when you put your stop where the market shouldn't go. So that's it. That's the entries. That's the high probability trend trade. That's the one that typically wins more than it loses. That's the one that creates confidence through the memory of success. That's the one that teaches you to read your indicators, guys. So I'm going to give you everything you need to be able to identify, take, and manage this trade. And chart reading 101. Chart reading 101, guys. This is your core. And this exercise is designed to get you in the habit of looking at your large chart, recognizing those advantages of momentum and path. Sorry, I'm having NinjaTrader issues today. Happens sometimes. Because once you can identify strong triggers and a clear path, you're going to see more. You're going to recognize more patterns. You're going to identify more opportunities. You're going to be able to manage more assertively. Man, I may have to do a full rebuild on my NinjaTrader this morning. So, in order to get to where you want to be the quickest, commit a little study time to those two concepts. Commit a little study time to momentum and path. So take 25 pictures each, guys. And I know it sounds like a lot of work, and man, why would I have to do that much? If you want to get to where you want to be the absolute fastest, this is the proven path. Because if you take 25 pictures of strong triggers and weak triggers, of a clear path and a termination, and you take the time to explain on a chart through annotation, this is why it's strong. This is the separation. This is the colors matching. This is odds favorable momentum. This is rule number 1. You're never going to confuse it with this is smalls inside of the large. This is weakness. This is anything can happen. This is rule number 1 not met. So this just creates that awesome foundation that allows you to recognize advantages almost instantaneously. So you're going to go fill up your spreadsheet so you know the difference between the two. And guys, that's something you're never going to have to worry about when it's time to look for a trade. That part's going to be so fast. As you take those pictures, I'm giving you the high probability trend trade checklist. And this high probability trend trade checklist is designed to give you the absolute best case scenario for entering the high probability trend trade. So it asks you on the checklist, is the market coming from a strong top or bottom? And then it defines it. A strong top or bottom is a no triggers through termination that reverses the market. And it shows it to you visually. Because if you always think of these words and you force the picture to match, you'll know the difference between a strong top or bottom. It asks if you have odds favorable momentum on both charts. Do I need it on both charts? No, it's a 13-2 advantage. But if it is on both charts, that's the highest probability scenario. And then finally, Or next, it asks about termination conditions. And then there's the picture. This is a termination. And this is a clear path. And that's only potential. So now you can go through, as you take your pictures to study, knowing the difference, making sure you're taking the right pictures. It defines your entries. And then the second page is a checklist. And I don't know why you wouldn't print this checklist out and put it on your desktop, laminate it, use a dry erase marker, or your most delicious crayon, whatever, because nobody in the history of this checklist has ever done worse than 70%. I've had engineers put it through the ringer, tested over like 400 days, and they're typically in the low 80%, guys, and that's pretty outstanding. With a little bit of solid management, sorry, I'm doing ninja stuff too here. I'm multitasking, be proud. With a little bit of management, with a little bit of getting out when the advantages are gone, guys, 70%, it's almost impossible to not make money. I've seen people do it, but it's almost impossible. So print this out. Learn how to get into the market. Learn how to have an amazing entry. Understand that great entries create manageable trades. And then finally, I'm going to hand you the plan. I'm going to give you that rock solid plan. And that plan is designed, guys. This is a stepping stone in your learning journey. This is your first trade, not your only trade. This is the one that teaches you to read your indicators. So this plan, this KISS plan, is designed to optimize your chances of success with the high probability trend trade. And when I say optimizes, I mean I don't know a better way to teach this trade to give it a higher win percentage. But through simulation, study, class feedback, and continuous practice, you're going to be able to create your own plan. You're going to see your patterns. You're going to find your trades, guys. And it's going to be based on your ability reading the indicators. And this is kind of the second piece of that document that I put in the room earlier. There's two things you need to know before you enter a trade. And the first one is, why will I enter? And that's what we talk about for an hour every day. Why will I enter? And guys, give it the lamest answer ever. Because my rules are met. Because my rules are just a description of a pattern that's been proven to win more than it loses. And if you verify that, I'm talking to you guys, if you study it, if you prove that to be true, there's no reason not to consistently enter when your rules are true. Your rules are going to help remove a lot of emotion, because you know that every 10 trades you take, you're going to lose 2 or 3 of them. You know that every 100 trades you take, you're going to lose 20 to 30 of them. 20 to 30 of them. So you take all of them to give yourself the best chance of that percentage. And then you have to understand why you're going to exit. And this is where most users trip up, because to exit a trade means that you are knowingly getting out of a position that may still be going the direction you thought it was going to go. It means that you're making a decision to exit a trade at trouble, that you're making a decision to be okay with not making more on that trade, and that freaks people out for some reason. Exits should be taken at profit targets, whether it's predetermined or trouble, or when the advantage that you had to enter the trade has gone away prior to the targets being reached. So if I enter a high probability trend trade and the market pushes 4 or 5 ticks beyond my trigger lines, I'm willing to exit that trade because my advantage is gone. If I enter a high probability trend trade and 3 divergences print, I'm willing to exit that trade because my advantage is gone. If I enter a 50-50 trade and divergence prints, I'm willing to exit that trade because my advantage is gone. And guys, these are the 2 things that you're going to commit to memory, that you're going to make second nature in the very beginning, because it's going to open the doors for everything else. We're going to define entries. We've done that. We spent an hour talking about how to get into the market where the market is most likely to continue. Entries aren't difficult. Entries, most of you pick up in the first week or 2. Management is where great entries get decimated. Management is where great entries pay dividends. That's going to be up to you. You've got to do something with that great entry. So I've given you a plan, I've written a plan that is the most mechanical approach that I could come up with. It's nothing but if then. This is a plan that if you give it 30 days and this is your whole management plan, you're going to learn how to manage outside of it, and it'll be based on your experience reading the indicators. But until you can read your indicators, this is a pretty outstanding way not only to define where stop placement goes, but also it gets you focused on getting paid. And that's the goal. The goal is to get paid, guys. The goal is to make money every day consistently. So at the end of the year, you're feeling good about what you've been doing, and you'll change your plan based on your ability to read the indicators. So this same plan that we're about to go through is here in the spreadsheet that I gave you under management on the client trade section. And it really is, it's dependent on your ability to define your entry, because great entries create manageable trades. So if the entry is 2 ticks below resistance inside of triggers, then the initial stop is 4 to 5 ticks beyond the triggers. Why? Because that's where the market should not go. This is where my advantage is lost. And the great thing is you will know where your risk is before the trade is ever entered. You know where the smart risk is before the trade is ever entered. So if you know that your entry is at 34 and you know that your risk is at 49, you have to make the decision. Am I willing to risk $150 on this trade? And if the answer is no, a better decision is to simply not take the trade than to put your stop by areas inside of triggers, than to put your stop in the retracement zone. So you have to be willing to jump into the kill zone a little bit, and that's just a part of it. Your targets are predefined at $100 and $200. If they don't hit your stop, it means it's going in the direction of the trade. So if a reversal bar prints in the direction of the trade, you're going to redefine where the market should not go. Your new stop is 2 ticks above it, and it's either going to get hit or it's not. Roll back, don't worry about it. But now you have 30 ticks of risk per contract as opposed to 150. I will, Better Dad. You got to give me a little bit of grace. You got to give me 2 minutes to go through the management so it's not an incomplete thought for 30 people in the room. But Lonnie, we're 2 minutes out, man. If price reaches your first target, one contract is automatically removed. Guys, the funds go into your account. And with one contract remaining, you're going to move your stop to break even with 0 risk and $100 in the bank. You're just learning how to trust the large chart. If it goes to your second target instead of break even, it's a $300 trade. And guys, $300 doesn't feel like a busy day, but it wasn't a busy day. That was 4 minutes of your day. And if $300 is the best you can do, that's 75 grand a year. Throw in a break even, you're into 6 figures. Guys, and I'm telling you right now, it's not making all the money. It's making the easiest money. It's making the best money. So, promised you everything you need. There it is in the zip file. Everything that we've done this morning. The PowerPoint, the Word documents, the trading plan, the management plan. You've got the spreadsheet. The only thing that you guys don't have at this point is the repetition for it to be easy. That's it. And then the second half of class is exactly what we're going to do right now with Lonnie. It's taking your pictures, and look what Lonnie does here. Lonnie says, check it out, Mark. I have odds favorable momentum. Smalls are above the large are wide. Everything is screaming up. This one had the potential to break because the small triggers got through. Mark, you've been saying incessantly for a week that I have to enter at the areas inside of triggers. Didn't get it on the way down, so I chose to get it on the way up with that confirmation bar. And then Lonnie, the only question that I have is why not get paid at the fib on the first one, right? You're trading gold here, so you were in it at 77.30. 78.30 right at the fib is $100. 79.30 is a $300 trade, Lonnie. So from your awesome entry, you could have been $300 up and out instead. You did take $200. but you gave it all back on the last contract. So I love your entry. Large chart's perfect. 3 divergences may terminate a trend, but you held, right? RTY, okay. So you've got to make adjustments. So when was the advantage gone, Lonnie? 3 divergences in the same price range. That gives you about a 78.30. So I guess that's 50 bucks. 50 bucks on the second contract, 100 bucks on the first. Could have been a $150 trade. Does that make sense? Management takes reaction time, and that comes with experience. That's an experience thing. And that's okay, and that's what I'm saying. This takes a little bit of time to learn how to react to it. But the cool thing is now when we're looking at a chart with absolutely no motion, no emotion, no anxiety, no adrenaline, you can go back and reannotate, and this is what's going to get you where you want to be. I didn't see it at the time, but a third divergence is a great exit condition because now my advantage is gone. Does that make sense? Yeah, and that's, man, I'm telling you what, hindsight, right? Hindsight is 50-50. So what you can do is you can take that, you can upload it, and this is how I would use these pictures. So Lonnie, there's no doubt in my mind, you took that picture, you dropped it into your trade journal. So now go back to your plan and drop that picture into the management section. And then tomorrow morning when you look at it, you're going to be just a little more aware of 3 divergences. And Lonnie, let me give you a little heads up, and this is for everybody. If on your large chart or small chart, you see that negative number, but there's no line yet, this is divergence potential. It's not true yet. So if you see that divergence potential and you already have 2, you might say to yourself, oh my gosh, if I see that line print, I'm going to have to. And notice how it's still potential. Now it's divergence. Now it's true. So that gives you a little heads up as you come through. Good picture. Great lesson there. Thanks, Lonnie. Let me go to the next one real quick because I know you've got to get to work. And you labeled this gap, right? That's what happened to you yesterday, Alex? 3 divergences got you? All right, so let's talk about the gap real quick. There is a gap between them, but Lonnie, when I reference gap in the room, when I talk about gap, I'm talking about the gap theory. And the gap theory, well then how did it get you? Did you exit based on the potential, Alex? You thought it might print, so you better get out? Yeah, I saw your picture. We're going to talk about it. So, Alex, first date, right? You pick her up, you take her to dinner, you brought her flowers, maybe there's some candy in there, you go see a movie. Alex, there is the potential you're going to get a kiss full on the lips at the doorstep. But until that kiss happens, it's just potential. Don't call your friends and brags. Don't ever make decisions based on potential, right? The indicators will let you know if your exit condition is true. And we'll look at your picture and talk about it because I've fallen for that one too. So guys, here's the gap theory. Lonnie, here's the gap theory and how we use it. So if price pulls away from the synthetic triggers, AKA the large, this is a large chart termination scenario, guys. If the price just accelerates away from those triggers super fast and it hits something, it hits a fib, it hits a mid-band, it hits a yellow 1-to-1. If the large triggers are a full bar away, so we get to Fibonacci and my large triggers are a full bar away, below the reversal bar, or in a long trade, they were above the reversal bar. This is the gap that we're talking about, guys. And price, because it closes back to the large triggers so often, that's why we get great entries. This is what defines the mid-band as a termination condition. This is what says, hey, don't even try it. This is what says check it out. Price is more likely to return. So Lonnie, when we look at your picture, all you have here is a termination condition. Does that make sense? It's not quite the gap theory. The large triggers would have to be all the way below this reversal bar marker. And then again, because I love real world, well there it sucked back anyway without the gap. Let's go see if we can find a gap on the S&P here. And there it is beautifully. See how price comes all the way back, smacks into fibs, and those large triggers just didn't follow. Some of you were saying, man, that was a termination. The small triggers rolled. I need to go short. The background's red. That gap theory says, man, listen for the sucking noise. It's likely to pull back all the way to those triggers. And let's see if we can find another. Even here, pulls back. Whoops. Trying to make it a little smaller. Down here, sucks back to triggers, sucks back to triggers, sucks back to triggers over and over. So guys, that's your gap theory. And it's the gap theory that defines the midband as a termination condition. Great stuff. Lonnie, did I get both of them? Is that it? Was it just the two? The gap theory better, Dad? It's nothing. The only thing the gap theory tells you, better, Dad, let me go to this one. The only thing the gap theory tells you is, let's see what this one looks like, is that when price hit these areas, don't go short because it's a termination. That's it. That's all it tells you as a brand new user. There's no momentum trade. There's no... Yeah, so all it says is don't go short. So instead of going short here, and do you see how that looks nice? Pull back to the mid band right there at the triggers better, Dad? That's a good look on the small chart. But the large chart is telling you, don't do it, better, Dad. Don't do it. Price is likely to suck all the way back up to these triggers. And man, you don't want to put $500 worth of risk on a trade. You're better than that. And then when they get back to these triggers, they're going to have to make a decision. Or if you choose to take this trade, you have to be prepared through your management. Lonnie, have a good one, man. Thanks for posting in the room. I appreciate it when you guys do. So first a pivot with a loss of momentum, not a termination. When price reaches the pivot and both triggers can't break, now it's a termination. Now there's a reversal. It's not a strong top because the large got through, but I have odds favorable momentum. I have a clear path. Pretty cool, right? Guys, I'm going to take 5 minutes. Post them if you got them. When I come back, we'll look at the rest of the pictures posted. We'll talk about any lessons we can talk about. If there's something specific you'd like to address, let me know. Look at that. Pulled right back to the triggers, didn't it? There's your live version, Lonnie. Pretty cool. So if you get short right here, you have to expect that. It's part of the retracement zone. And if you put your stop hovering in here, it got absolutely slaughtered. I'll see you guys in 5. Post them if you got them. All right, guys, here we go. Better Dad, you'll be back in an hour. Man, school must be far away. No worries. When you get back, we'll look at your charts. Or actually, I'll probably go through all of your charts and you can catch them on YouTube if need be. We'll see where we end up. So guys, this is the second half of the day, is where we go through and we look at what you posted. I know Bob said that he's working in the home office today. He'll come back and check YouTube, so I'm making sure YouTube is good and going. And we're just going to look at what Bob has posted. We're going to talk about advantages. We're going to see how we managed. And I'm going to give Bob any feedback I'm capable of giving. So here's the first one. Strong bottom, termination condition. Reverses the market. That's amazing. And Bob says, check it out, Mark. It's not a clear path because there's a divergence high here. I see that divergence high. I know it's a termination condition. But I'm looking at my momentum, and because of the strong bottom, and because I can take a relatively low risk entry, I'm willing to take a shot. I'm willing to take a shot into that area. And it works out. He gets in. He got jumpy and closed the trade. Sometimes that happens. No advantage is lost up here. But it comes back and he goes, wait a minute, it's more likely to go to the fib with all this momentum. That's what the pattern says. And sure enough, it does, and he takes it. Nice recovery. 2 trades, $600, easy peasy. Nicely done, Bob. Next one, let's see what this one said. This ended up being an exercise in tight management of the trade. So, weak top, didn't quite hit the fib. Bob, remember that fibs are the result of thousands upon thousands of calculations. If it misses it by a tick or two, and you get divergence, and the triggers aren't anywhere near, sometimes you can go, man, that's pretty darn close. And then again, odds favorable, directly into a termination condition. It pulls right back to the large triggers. And Bob, you decide to take the trade. Your initial stop was way outside of everything. Your initial stop, where did you enter? You came back on the 06 pullback. So you're in down here, not up here. You're not trading into a termination condition. You're trading a 50-50. Guys, I love all the arrows, and it's awesome. If it looks exactly the same all the way down, don't be afraid to circle an entry for me. So you get in on the pullback to resistance inside of triggers on a 50-50. Stops a little big, but it works out. And then it's just railing down. And this is brilliant, guys. This is a management picture all of you should steal. So instead of a lot of risk, he catches it on the confirmation. He says, you know what? I know I can move my risk behind it if I get a reversal bar. Let me force the confirmation. He gets in right at about 10. It costs him a couple ticks. That's okay. And everything says down. Everything says down. Everything says down. And he uses these pullbacks, these reversal bars, right at the large triggers, and just chases the market where the market shouldn't go. And then finally at 95, he goes, man, that's the edge. That's the edge of support. I'm not going to be greedy. I'm going to get the hell out. And that's a beautiful trade. Awesome execution, great job on confirmation, and beautiful management, trusting the large chart. Bob, gold star. I hope you're smiling when you hear this on YouTube. Next one, weak bottom, not a termination condition that reverses the market. Odds favorable momentum, absolutely. Clear path, 100%. And man, that darn pullback didn't get to the areas inside of the triggers. So Bob says, wait a minute, with this momentum, with absolutely nothing in the way, I know that's my core. I know that's the basis. I know great things happen with this look. I'm going to jump into this market with all that momentum, and I'm going to see if they hit trouble. And they did. Another great execution, Bob. Another great chart read. They didn't give you your best entry, and you chose to take a chance and say, there's so much momentum and nothing in the way, it's probably more likely that it goes up than down. Really well done. Strong bottom, odds favorable, not a clear path, right? Potential to break. Does everybody see it? Not a clear path at all. This is, and it's this trade that he's taken, I think, at 26, maybe 26 fib, 26 fib. So it's momentum and potential. Can you guys give me a Y if you see that? Not a clear path. A clear path means that the small and the large are above the area. This one has the potential to break, but check it out. All the momentum, all the potential from a strong bottom, no divergence, perfect entry, beautiful execution once again. Bob, I'm starting to feel like you found your mojo. Uh-oh. Uh-oh. And then he stopped following rules and he started thinking. I was thinking strong momentum and a strong run to the upside. So even though I was thinking this has to go, I didn't pay attention to the fact that I didn't have a clear path. I didn't pay attention to the fact that there was divergence. So Bob, you were looking to just jump in, right? Man, I sure hope. So let me give you a little something. I'm going to drop this in the room. So when you come back later and do the chat box, and guys, this is compliments of Ron. If you're just going to jump in expecting momentum to carry you, you need to get past the things that could stop forward progress. A lot of you guys see people in this room taking a trade that they call the chili dog. And the chili dog says, man, with all this momentum and nothing in the way, I'm gonna see if I can take advantage of it. But the first rule on the chili dog is the back of your bars have to clear anything bouncy. And they didn't. And it results in a loser. So I'm going to drop this one in the room for you, Bob. I know you're coming back later to take a look at it. There's a little annotated chart for you. Great stuff. And guys, if you ever can't make the room, don't feel like you can't post, because I'll still go through each and every one of them. All right. We'll come back to better dads. Roy, good morning. So Roy, why is it a good top? I'm going to go through the language a little bit. I'm just going to write the definition of a strong top. And a strong top is a termination, no triggers through, reverses the market. So this is what we actually call a weak top. You're at the very beginning of momentum, absolutely. But you're also directly in determination conditions. So you've got terms, no clear path. You've got multiple losses of momentum right at the termination, and your entry is directly into the termination. So we're gonna break it down. We're gonna do happy and sad. The happy is that you're trading with the trend. The happy is that you're trading with momentum. And guys, I say it every day, momentum can cover some mistakes. The challenge is that you're trading directly into an area that has the potential to stop the market. And you took that trade directly into that fib, 100%. Didn't even give it the opportunity to try to break. Sometimes on looks like this, letting it get below the bouncy stuff on the small chart creates a little more of an advantage. You've got the momentum. You're missing the path. You had the entry. So check this out. You had the momentum. You're missing the path. You had the entry. So Roy, what you just took is what we call a medium probability trend trade. Almost everything is good, but not quite. Manage assertively. Does that make sense, Roy? Awesome. So the only reason that I say that is because if you identify that this isn't perfect, if you identify that the path isn't clear, Roy, it just gets you on your toes a little bit. It says, all right, man, if I get a third divergence here, if it bounces up and tries to go, I'll probably exit because it's not breaking. But it never even gave you an opportunity. So I like it. Nicely done, Roy. And guys, remember, if I give you feedback on a chart, if you don't agree with it, if you don't understand it, raise your hand. Let me know. It doesn't hurt my feelings. I like it when you guys challenge me a little bit. Boaz, you are as boring as flowers are pretty. Strong bottom, odds favorable, nothing in the way, perfect pullback. So what's the only challenge? The only challenge is that your areas are not inside of favorable large triggers, which means we're missing rule number 3. Does everybody see that? And once we get below these triggers, we don't know if or when it's going to stop. So Boaz played the odds. He said, Mark, I have the greatest momentum ever. There's absolutely nothing in the way. And Mark, there's this lesson that you teach every day, that if price reaches Fibonacci support and every trigger is above it, absolutely no short trades because it could stop the market. Boaz knows that it stands to reason. If momentum up is hard to stop, if a clear path makes it difficult for it to stop, and if a termination says don't go short, he says, I'm going to go long. I'll give it a couple ticks. And you did it beautifully. Really nice job. Bad exits, 2 contracts will be much better. I agree. I like 2 contracts. I don't think it's a bad exit. I think you got out at a potential pivot stop out. And with 1 contract, why not get paid? Why not get paid? As long as you didn't exit because of the potential. All right. Alex, you with me? Does this chart have anything to do with this chart? Are you using market flow for entry? Guess is not an answer. Did you have rules met on this chart? And the only okay, so I want you to do this for me. Stop showing me that chart because these are huge, brother. And even more so, if you wanted to, you could just show me that. And that's enough. Does that make sense? Look how clear this is for everybody. So Alex, we're going to go through it. What does clear patch mean? You had space between here and the fib? I want to make sure that I'm reading this the way you're reading it. That way any feedback I give makes sense. So is this your clear patch right there up to the fib? Oh, so you had odds favorable momentum. You had a separation between the small and large. That's the clear patch you're talking about? Dig it. Because your arrow goes right to a fib, which is a little misleading. So you're saying, I got momentum. I've got great momentum. How do you feel about your path? There's not a clear path. You're directly into a fib, right? Okay, but so momentum, and thank you for saying that. So check this out. Hold on. Let me find my picture real quick. So here's momentum. Momentum acts on its own, ladies and gentlemen. Entered trade, waited for pullback, clear patch. But we decided clear patch. Oh, there it is. Odds favorable. I like it. So what's the clear patch? Because you said the clear patch was the odds favorable momentum. Is the clear patch above the fib to the next fib? I just want to see how you're reading this. It's okay. Alex, what happens is we take 3 or 4 pictures and then I start to speak your language. And that's all I'm doing right now. So you're saying, I'm just making sure, correct me if I'm wrong, momentum leads the way. Momentum is amazing. Momentum is outstanding. The momentum here is 32 flavors of kick-ass, right? I love it. That's a good look. And you said, I don't want to trade into a fib. Fibs are where bad things happen. So I'll let it break and pull back to that fib right inside of triggers. Instead of trading directly into trouble, you chose to trade from trouble. Does that make sense? Am I there? And then you said you entered up here, which I think is pretty late. Take advantage of those areas inside of triggers, and you make a little more money on the way up. So you had momentum. You were void of path. You had an area inside of triggers. You had 2 out of 3. You took the trade. You're not willing to lose. It's up by things that could create bounces. I love it. I don't know, $230 above my entry. 02 to 25. Why not lock it in a little bit, right? Get paid. Beautiful. I like the trade, Alex. And the patience of waiting to get to the other side of the fib. Sometimes it's the difference between fast losers and great winners. Because small triggers are through, the momentum is outstanding, and this area is likely to create a bounce. And you move the target fill times, nice. Great job, Alex. Sorry, it takes me a second sometimes to get on board with what you guys are thinking, what you're pointing out. Because remember, I'm an artsy-fartsy kind of guy, so sometimes my brain goes a little sideways, and I apologize for that. And I lost my spot. I got Roy's, I got Lonnie's, we got Boaz. Who's this young fella? He says, check it out. Strong trending market. Good morning, Wayne. Strong trending market, which means rule number 1 is met, odds favorable momentum. And there's that good example. Let the back of the price bar clear anything where decisions are made. And just zoom that bad boy. Unusual for this trade, but you waited out the retrace. Quick profits based on momentum and path. Really nicely done, Ron. Really nicely done. Roy. Everything is great here. Can I enter a trade? You can do whatever you want, Roy. That's the beauty of trading. Do you have rules to enter a trade at 66.85? Because you say everything is great here, and it was right here. Somewhere about right here, into a fib. But it looks like it's coming from a fib. Roy, could I talk you into giving me the same picture where you don't cover up the large chart? Because this particular look doesn't fit any rules that I have. None at all. But if that's a strong bottom, you've got the right idea. You do have momentum. It looks like you have momentum. If you wanted to take a chance on momentum, that's about where you would do it. But for me, well, and you're asking me what color is your car? I can't see it. So for me to feel good about a trade, the synthetics are down, right? There was resistance here. I'd like to see where this trade was coming from. Because what you're pointing out here is kind of a momentum trade look, which I like. I like it a lot. But the first rule for that trade, Roy, is a strong top or bottom. And in this case, it would be a strong bottom. And that's crude oil. Is that this morning? And all I'm saying, I'm not knocking anything about it, is that I need to see where it's coming from so I can give you a better answer. Because man, if it's coming from a termination that reversed the market, that's a pretty solid taking a shot at it. But what kind of trade is it? Because you don't have odds favorable momentum on the large chart. You do have it on the small chart. Do you see how if you took this entry, the real advantage is odds favorable momentum on a small chart, right? So how do you manage it? If I take a trade that is solely based in momentum, you have to have an exit condition. You have to have a reason to get out of that trade if your advantage goes away. And guys, that's why I talk so much about naming it, knowing what you're in for. So Roy, I love it. And until price closes on the wrong side of these small triggers, it's going to keep zinging up. Looks like you found a good way to capitalize on a strong bottom using the momentum of the small chart. Does that make sense? Is it high probability trend trade? Absolutely not. Is there a potential trade there? I would say yes, 100%. But I don't have rules for it. It doesn't fit any rules that I teach or that Nexgen presents on their website. But it's a close relative of this particular trade, which is a momentum style trade, which starts with a strong top or bottom, nothing in the way, and then using an entry at an area right at the small triggers, which you did perfectly. And you have the clear path. Let's see if I can find a picture of it. That's very much what it looks like, only you use the mid-band. And it's just momentum screaming. I like it. Is this where it's coming from? Yeah, coming from a strong bottom. Makes it even more likely. I like the trade, Roy. I like the trade. And it's because of this that one was probably so successful. Because you were getting in right about there, right? Dig it. I do. I like it. I like what you did there. And that's the piece of the puzzle. That's the one that makes me either feel great about this one or go, oh, that might not be my best chance. And you nailed it. Beautiful, beautiful work. Morgan, odds favorable, potential to break, strong bottom, no divergence, perfect entry, beautiful stop, quick profits, and then you get out. Because you're like, whoa. It didn't even make it back up to the fib I was hoping would break. Great job, Morgan. Great management. Should have went for round 2. Rules still met. Were they? You had a divergence. I don't know. I don't know that the rules are still met. Not only could they not retest the fib, Morgan, they're losing momentum. This tells you, oh, I should have done it again. This says we can't even get back for the retest. Yeah, if it was a high probability, absolutely, back in. Great trading, though. Nicely done, Morgan. Let's see where we're at. Ron, Roy. Morgan. Jerry. Strong triggers, small past the fib, 6701, 6701. Back of the bar. Okay, so the smaller through. All right, good lesson here. You ready? Jerry, are you with me? I know you're working that chili dog, right? See that divergence high? Or that divergence? The 1-to-1? Ruined your good time, didn't it? Created the bounce. So the chili dog happens right here. When the back of the bar clears something that could create a bounce, and then from there, it is just straight money all the way up. Because this isn't broken yet. Has the potential to break. Your chili dog entry, per the rules, is about right here. When the back of the bar clears, there it is right there, 67.15, 67.15. You're in at 05 into trouble. You're into 05 before the back of the bar clears. Does that make sense? Just for consistency on the chili dog. Because this right here, hell, that could still stop it. Your small triggers aren't even through. And let me blow that up and show you what I mean. Where your entry was, see how the back line of those triggers are still below? You haven't even turned this into a 50-50 yet. This look is so much more dangerous than this look, trying to take that chili dog. And you can see the stutter. Yeah, just a little premature. And then it just rails. Absolutely rails. And then you get out of trouble. I like it. I think that entering on this side, Jerry, is going to keep you from catching those. Man, I crashed again. I'm going to have to rebuild everything. It's going to keep you from having to suffer these little stutters because there's just nothing bouncy and it doesn't stop. I love it. Great trade, dude. Guys, if you'll excuse me for 30 seconds, my dog needs to go out. Be right back. All right, the dog says thank you and she appreciates your patience with her. Let's see who next. Jerry, we got you again. Oh, same trade. The trade's so nice you post it twice. Did you mean to double up on that one, Jerry? Or was there one that you were hoping was on the clipboard? Sometimes I forget to reload. Same one? So I'm just going to say same lesson as the one we just talked about. Were you afraid I wasn't going to get to it? That happens sometimes when people are newer. I posted it and he didn't say anything. Oh, no worries. No worries. Have you met me? I don't worry too much. All right. So, heartburn into the gap. So, Wayne, you're trading against the gap. You're not trading into the gap. You're going long as price is absolutely sucking back to these large triggers that were a full bar away. So your long trade fights the gap theory 100%. Does that make sense? And you did get a little stutter. And then your second trade is trading with the gap. First trade's against it. I know it's your heartburn trade. And that's a great look for your heartburn trade. and then quick profits, and then you actually trade the gap. Make sense? Cool. I like it. I think it's pretty cool that you had a trade to get you up to the trade to get you down. That's pretty awesome. I just said that because it said heartburn into the gap. All right, let's see what else we have. Mom JTFI, I love it. All the momentum, building momentum, and then this is a good example. Jerry, you'll like this one too. Check it out. So with this chart screaming down, with this chart going down, right at that bouncy point it goes up, right? That's why on the chili dog, you let it get past these lines. Well, Wayne's been doing this long enough. He goes, well, the small crowd tried, and then they failed. And when they failed, I'm going to get in there to go with momentum. And boom, there it is. And this is the same thing. The small crowd tries, smacks into that fib, and then it continues down. And Wayne does a great job of trading away from the area instead of to the area there. And that's a good lesson because it kind of goes back to yours. Let that one-to-one clear. Get on the good side of things. It just makes it easier. Nicely done again, Wayne. And then here, it's nothing but momentum and path. And it's not a chili dog. You traded directly into the fit. Price is not below. 0225. It's just not below yet, Wayne. You're trading right at the one-to-ones. Price is below down here where the price bar is below. Because look at that. That one hit and created a big bar. That one hit, created a bar, Yeah, so for the chili dog, the back of that bar has to clear. Same thing. Great look on the large chart, strong trending, everything down. It's just these little things that create hiccups and mess up the good time. Good stuff though, man. Nice trading. And then pulls back, buying the mid band with a strong trending market. Amen. So guys, what's a strong trending market? A strong trending market is 30 bars in the same direction. No reversal bars. Breaking areas. Alex, have a good one, man. And Wayne knows that when you're strong trending and there's nothing in the way, just keep selling the mid band until it stops working. Great job. Great job. And then you didn't trust it so much on this one. So I have to point this out, Wayne. Buying the mid band with a strong trending market. Oh man, shit got scary. I'm not going to do it again. What happened? Why didn't you sell it? You nailed it on this one. What was different? Here the triggers are up strong. Here they're not even out of the other ones. Same look here, right? Just the market moving fast, still waking up. That's fair. That is fair. I had that this morning too. My brother was laughing at me. So with the trading view, one of the things we use is this indicator called a VWAP. It's on there, and for whatever reason, the VWAP stops stuff cold. I exited at the top of my small triggers believing it was the VWAP before I had a cup of coffee. It was kind of funny. Cut my trade totally short. Chili dog fail with momentum trade after. Smalls are on the wrong side of the large to feel like momentum is great. Hard to take a momentum trade. If the small chart, smalls are on the inside of the large. They're on the totally wrong side of the large. And divergence, everything, it does fail. That happens. And then over here, you take the mid band. It is still strong trending, 100%. 100%, still strong trending. And then I love it. Mid band hit, you catch it on the way down, easy money. Great job. Wayne putting on a clinic this morning. Did we see that one? We did. There's a smoothness to your trading that seems to be coming up. All right, let price clear by an extra tick or two because the market was moving slow. Fast crank up once it clears large triggers, base hits, buy golf. So for you chili doggers, you're like, but Ron doesn't have odds favorable momentum. He doesn't. But he waited for it on his small chart to at least give him a fighting chance. What Ron did have was a weak top that pulled all the way to one-to-ones with the gap theory. And when everything started heading up again, that's when he took his shot. Little unorthodox. Really great execution. Went yesterday. Ready? Ready? I played 9 holes yesterday. You shot a 79 yesterday, Ron? What'd you get on the back 9? I shot a 45 on 9 yesterday. I played the oldest golf course west of the Mississippi that's still running. It was fun. It's short, but it wasn't easy. It's a 9-hole that you can, it's pretty cool. You can pay $18. It's only walking, but you could play it from sun up to sundown if your legs could handle it. Pretty fun. All right, Andy Man. Large charts, odds favorable, potential to, oh, maybe clear path. Odds favorable, clear path, perfect entry, quick targets, ignored the third divergence and held it down to the next one. Nicely done, Andy. Momentum and path. Your charts look different every time I see them. And Wayne, you've already posted this one. It's still pretty nice. But you've already posted this one. Ron, one day I'll shoot a 79. When I can finally get into the 80s consistently, I'll come to the Carolinas and play with you. Good second hour. Yesterday's course was hard. Every green is like 6 foot elevated with a rock hard slope coming down. So if you miss the green by 2 feet, it ricocheted 40 yards to the right or the left. Had a couple of those. Stupid greens. Golf is hard. I don't know why we play it. All right, guys, there's our second hour. I'm going to go run a lap again because that's what I do. Stretch your legs, guys. Walk away if your rules haven't been met. I'm going to try to rebuild Ninja real quick. So it's going to take me a minute. I'm going to go through and I'm going to completely rebuild. I'm going to delete everything and I'm going to rebuild. I'm going to reset data. So guys, start a timer. Let's see how long it takes to get that done. I will be back and I'm going to say 7 minutes is my call. So talk amongst yourselves. All right, guys, how long was that? That was a complete rebuild, 100%, deleted everything, re-downloaded the software, and now I'm up. And guys, I am a tech midget. I am not so good at the tech. What was that, about 5 minutes, 4 minutes? That's how quickly it can be done, guys. The only challenge is now you've got to come through and put your charts back where you want them. But I deleted everything. I reran indicators. With the smoking fast computer. Yeah, that helps for sure, Wayne. It really does. But if you have a problem where things keep deleting or keep dying, if your NinjaTrader keeps crashing, sometimes there's corrupt data in there. Sometimes that corrupt data is the reason that it's happening. Yeah, I'm running full horsepower on this thing. So I've got my S&P coming up right now. And then we'll get that over here in just a second. I've got to let it load a little bit so I can put it over here. Even with the smoking fast computer, the S&P is a slow loader. There's a lot of information on the S&P. NASDAQ tends to load even faster than the S&P. I don't know why. So guys, we're coming into the last hour. This is where I rely on you guys. This is where I say, hey, Alpha 1, what's on your mind? What can I help you with? JK, what's new? What can I do for you? Alex G, I love seeing your name in the room. How can I help? Zahir, what's the haps? What you need help with? Sid, Surgeon, Bogsy, Steve's in here. What's up, Mr. Trimper? I love helping you guys, but I don't know if you need help if you don't ask. Here comes that S&P. Man, we'll see it when the synthetics come in, but that's a pretty good look there on the S&P. Taking it all in, Alpha. How long have you been with me? It looks like a new name. Usually my people tell me when I have new guys. 1.5 hours, right on. Well, welcome to Nexgen. So Alpha, this classroom is designed to build this awesome foundation for you, to get you a real simple approach to what we do. I'm going to drop a Word doc in the room for you. Check it out. This is the Trend Trade Simple Word doc. So everything that I do in the first hour, let me give you a little introduction. I'm sure you've heard this, but so live 5 days every week, guys. I'm going to teach you 3 rules on 2 charts, and I'm going to teach the same thing every day. Every day, we're going to talk about the same thing. And the reason we do that, the reason that repetition is so key, Alpha, is because your first 2 or 3 days feel like this. And I know that it feels like this because I've been there. I've done this as well. But this goes away after a couple days, because what we do is we go through and we talk about a couple advantages and we talk about how to turn them into the trade, and we talk about the same thing over and over. So everything that I talk about for the first hour, Alpha, has been consolidated into 2 pages here. So if you want the cliff notes to what we do, take that one, give it a little perusing. And then if there's any questions you have on it, the class revolves around, participation. The class is 100% participation based. Every morning we talk about rules. Every morning you have the ability to simulate and to take pictures and to ask questions. So every day, 5 days a week, 15 hours a week, it's a 100% live discussion where anything that you post, anything that you ask, it gets addressed, it gets answered. I begin to recognize what it is you're doing and how you're doing it, and we start working together to do it better. So welcome to the room. Get in the habit right now that it's okay to ask a million questions, and I appreciate each and every one of them, and it's nice to have you here with Nexgen. And then what you're going to learn is this pattern right here. That when the momentum is strong and the trend is down and these areas have the potential to break, that you can sell an area of resistance inside of triggers and more often than not find a way to make money. Pretty cool. Great to have you. So Joel was like, man, yesterday the market was a bit weird. I agree, Joel. There's a reason that I was playing golf yesterday. Yesterday was FOMC day. Happens once a month, happens on a Wednesday. And on FOMC day, they do all the economic projections and statements and press conferences and the funds rate. And the market goes absolutely batshit crazy. Sometimes for 5 minutes, sometimes for 5 hours. This is golfing day. Even Ron said he went and golfed yesterday. I agree with that 100%. But what happens, Joel, is when you have a day like this that is so, it's such a high impact news release, sometimes the market scrambles before. And they're jockeying for position based on what they're hoping the economic release will be. There's people that just trade news. We don't do that. We trade patterns. And that's why it probably seemed a little off. And just for grins, that's probably why my stuff is suffering today, was that move yesterday. But hold on. What is today? The 20th? Today? So that's today. Let's go look at what it looked like when FOMC hit yesterday. So FOMC hit at 2 p.m. So check it out, Joel. There's the beginning of FOMC. That was 4 minutes later. It jumped from 32 to 60. What is that? 28 points. And then alpha, do you see where the market stopped and all of that psychosis that was created? This is why you come to Nexgen, my friend, because you're going to understand areas that can create untradeable bounces. You're going to be able to recognize areas that can stop the market. You're going to recognize patterns that take away your advantages, and you'll recognize your advantages. And I mean, that's the 10 minutes. That is 10 minutes in the market based on news. It's pretty awesome. And that's what we do every day. Joel. Strong triggers with momentum. Room to the target. Oh, I like it. So Joel, I wish I had a little check mark. I don't. I typically trade about 10 to 15 minutes every day, but the classroom is 3 hours every day. Alpha, I don't call trades. I don't trade live for you guys. I teach you guys patterns and rules, and then you get to make your good decision on trades. And then every time that you post in my room, I'm here 3 hours every day. So Joel posted, and Joel went back to the really core of what we do here. He said, Mark, I had strong triggers. And that's rule number 1 for us. That's the first rule that we teach every day, is making sure that your market has strong triggers. So you'll learn about this tomorrow morning. And then Joel says, Mark, there was nothing in the way, and I had a clear path. And that's rule number 2 for what we do. Making sure that you haven't reached a key area, making sure that you've gotten past all the other areas. So Joel's taken 2 advantages on his large chart and said, I'm going to go find a way to enter the market. Sounds pretty cool, right? So what Joel didn't do is Joel neglected to write the 3rd rule on his chart. And the 3rd rule says use a limit order at areas inside of triggers. And what Joel failed to recognize is that that area wasn't inside of triggers. And once you get below this area, who knows where the market's going to stop, if it does at all. So Joel, yeah, it was right before FOMC, but you broke rule number 3. You actually entered where the market shouldn't go. You entered where the advantage was gone. So this is why we talk about 3 rules. Rule number 3 says to buy a pullback at an area, and then the key to that is that it's inside of triggers. Does that make sense, Joel? Because this is a great example of when the large chart is perfect and the small chart isn't giving it to you. And that's why, call me crazy, ladies and gentlemen, that's why I firmly believe if you take the time to annotate with all 3 rules every time you take a trade, you're going to divorce me eventually. And it didn't give it to you? Did it just drop? It dropped huge from there, didn't it? No? Let's see what it did. Let's see if we can turn it into a lesson. 13:52 yesterday. Are you in Eastern time frame? Is your computer set to Eastern or is it set to Central? There's my 13:52. It is set to Central, so that would be 12:52 Texas time. I'm in Texas as well. This doesn't look right. All right, so I can't find your trade. I'm not sure where it was. Was that yesterday? It couldn't have been today because we're not there yet. And this is why I love to see, guys. I love to see what the market did after. Because, Joel, there's another line of thinking. So let me give you the other side of that entry predicament. So do you see how Rule 3 isn't met? We talked about that. So here's kind of the other side. If my large chart is perfect, and Joel, your large chart was about the sexiest look you could ever have for a trade, but my entry chart is not, many people will wait for that reversal bar in the direction of the trend. And what that does for you is if you get an up bar right here, well, now you have some place to throw a stop since you're already on the other side. It doesn't guarantee a winner, but if you never get that bar, it also it helps avoid the loser. Does that make sense, Joel? Because when the chart looks this good, man, I want to be a part of it, but I don't want to arbitrarily jump into it. Good stuff. I mean, the large chart read is 100% spot on. Just didn't have the best looking entry. Strong top, odds favorable, 50-50. Take the first shot in the retracement zone, lot of risk. Money, money. Didn't take the second shot because it looks like it had already reached the fib. Nice trade, Boaz. And this is one of those times, too, where you could say, that's a lot of risk. Maybe I'll let it start in the direction of the trade. Maybe I'll wait for a reversal bar. And it's nice to see you doing the... it's okay. It's not your mistake, Joel. You're learning. What part of Texas are you in? And you don't have to answer if you don't want to. You're in Dallas? Right on. I was in Dallas up until November this year. I was just north. My wife was working at a hospital in Denton. I grew up. I went to high school in Dallas. Very familiar with it. So this is the same one. And Boaz, I love that you're doing 2 contracts on this one. 4 contracts. No, it's 2, sorry. Great entry, getting paid, out with divergence. Nicely done. And then, yeah, I agree. I think you probably missed that one. Odds favorable, perfect entry. Could have got out of trouble. Really nice. Really nice. And then Andy says you don't want to overtrade. Sometimes 20 minutes is plenty for goals met. Mark's class is 3 hours though, so you can get feedback all the time. I don't know. You can't see it, but this morning before classroom, all I take is trend trades. And this morning before news hit, I was up about $1,300 on a 2 lot. And I was probably in the market for a total of 7 or 8 minutes to do it. Just following rules. I love rules. There we go. That's the same one, right? Same look on the wrong side. Chili dog money. I like it. Enjoy your afternoon, Ron. Appreciate the time you spend with the people. So this one crashed way down, right? And it went way down to 34, Joel. And then that's the exact same look. And even this is the exact same look right here almost. Just so what's cool, and Alpha, this is how this room works, is Joel, everybody makes mistakes. I am awesome at making mistakes. I've made lots of mistakes. I still make mistakes. But the cool thing is I've learned how to fix them. Which means that every time you guys present an entry on the wrong side of triggers, we can talk about how great this chart is, and maybe there's a way to reduce risk. Maybe there's a way to have a little more potential for a win. And Joel, your large chart is solid, dude. 100% solid. Which means, and this is the order of operations, it means that you understand the core. You understand the foundation that we try to build in this room every day. And now you're just working on entries a little bit. And those tend to take just a little bit longer because there's more words to memorize. For sure. Great job, Joel. Let's see what the large chart is doing. There's that gap theory again. Does everybody see how price came back to those large triggers? Especially from a bad bottom. Not a strong bottom, not a termination that reversed. And then when they get down here, they're going to start making decisions. Pretty awesome. So that is the S&P. What other market did I open? I do have crude oil open. Oh, Joel, here's a good example. So check it out. The market is awesome, and it gives lessons. So guys, give me a Y in the room if you see that this is strong triggers. And remember, strong triggers has nothing to do with price bars. Strong triggers has nothing to do with fibs. It's just separation between small and large. Pretty cool, right? Now look at this. All of my triggers are above resistance. And what that means is now I have a textbook clear path. Everything has gotten past trouble. Trouble has become support. You guys good? That's kind of tough because I don't know where the triggers, whoops. A lot of times with this look, triggers maybe are up. So we're just going to pretend, guys, that the areas fell below these triggers. And Joel, this is just the lesson that I was talking about. So if we're like, man, they're below the triggers. I've got a mid band here. And guys, I realize now that that qualifies as an entry, and you might have had to take this trade twice. So let's say you take the fib, right? And you lose. And guys, losing is a part of winning. It really is. And then, Joel, you're like, but my large chart's still perfect. My large chart still has momentum. My large chart still has a clear path. There's that confirmation bar, right? And that's the one that zings you off to the distance. So that's what I'm talking about. When the entry isn't perfect, but the large chart still says go, it's that up bar. Gives you something to put your stop behind. Does that make sense, Joel? Because I think that's the look that you could have used on yours. Good stuff. Miss Jen, oh, I thought you dropped out of the room. So sad for a while. Strong top, odds favorable, 50-50, divergence, perfect entry. Talk to me about that exit. Oh, good for you. Do you want me to guess? Can I guess on the exit, Jen? Guys, I'm going to show you something that's pretty common here, and Jen knows that I'm going to see it. So Jen's target was right there at that divergence low because this was a 50-50 trade. And Jen said, I'm going to get paid at trouble. And then it missed trouble by a tick. And when it started up, Jen said, oh shit, this is the end of everything. I better get out of the trade. Jen, if I had a nickel for every time I've done that, I wouldn't need to day trade. Guys, this is common. It really is. And I'm going to show you something that's pretty cool. So, kind of. Right up until I put a ring on your finger, and then that stopped with my wife 30 years ago. So Jen, let's use the phrase, what changed? The large chart never blinked, right? It's hard to lose those advantages quickly. It's a slow-moving chart. So from your time of entry, let's talk about everything that changed. Well, the small triggers rolled in the direction of the trade. That's a plus. Price started moving to the other side of those small triggers. That's a plus. Wayne, lots of work this week and watch market for maybe 5 hours total, up 2,500 bucks. Got to go to work. Dude, Wayne, that's amazing. Your trading was just spot on today. You got cat-like reflexes working these days. Have fun tuning those engines, man. We'll see you tomorrow. Thank you for being here. So, one of the greatest ways to work on management is the awesome question, what changed? At the time of entry, your first change was the triggers rolled and started going in the direction of the trade. I love that. And then nothing else changed. It just kept getting better. Everything kept going down, kept going down, kept going down. And Jen, sorry to turn yours into a lesson there. I want you guys to see on a small chart. Watch this. I don't even have stops and targets. Look at my large chart, look at my small chart. I want you to see how many times that number changes and the market doesn't go anywhere. And hopefully it works through it. I actually have odds favorable and up. But I'm down money. It went back up. What's it going to do now? Oh, now it's down another tick. Now it's up a tick. And now it's stuck. And I have to think about my position. Oh, now it's up another tick. Oh, it's down a tick. Notice that the large chart hasn't moved. The large chart hasn't done anything. If you hyper focus on the small chart, if you let the small chart talk you into or out of things, you're going to get talked into or out of things. Guys, it's still just dancing there. Is the S&P moving more? I'm up money, I'm down money. And look at the tail, right? Oh, I'm up money. Oh, I'm back to break even. It's crazy. Guys, this right here destroys great trades. Hyper focusing on the ticks absolutely destroys great trades. And it costs you a lot of money. Because by the time your brain registers, oh shit, I shouldn't be in this trade, it's usually the bottom of this bar, right? Or it's the top of that short bar. And I only know it because I've done it. Because I've done it 100 times, guys. The same way you'll probably do it 100 times until you learn how to ignore that chart. And that's one of the things that, let me see if I have the picture. Absolutely. Jen, it's hard not to. But guys, so this is your small chart. This is defining entries. And Alpha, you're going to get to the point to where you can do this, where you can pinpoint the best entry. But the human brain is a royal pain in the tail. And your brain is going to tell you things like, man, you better jump in or it's going without you. Has anyone other than me ever just jumped in hoping that the market, and then sure enough it retraces and you lose money and you're mad? Done it. And then it's almost to your perfect entry and that small chart starts to go up and you say again, oh my gosh, I'm never going to get paid because it's going without me. I'm not going to get my entry. I better jump in. And you end up at the high tick of a bar that wasn't even a reversal bar. And then it goes back down and you panic and you exit. And then finally it hits your best entry. And you're so beat up and exhausted from chasing ticks that you miss the trade. And guys, this is so common that I don't even remember when I made this picture. But the market is comprised of up and down ticks. And when you give tiny little ticks value, you've got, this is crude oil. There's $100 worth of movement inside of this bar. There's $100 of movement inside of this bar. And it's so easy to focus on it. So Jen, thank you for posting that picture. That's such a great lesson. And again, guys, this is one of the advantages of this classroom. I've made every mistake. That's why it looks like I can read your minds. Because I look at it and I have an inability to forget things, which is good and it's bad. So I recognize this. I see myself in this. And then I get to tell you how I overcame it. And I think that pays huge, huge dividends. But that was your momentum path, pull back to support at the triggers. I hope somebody took that trade. And that was your momentum path. It was right at the top. That one probably got you. But this is a pretty common pattern. A weak bottom, pulls back to fibs, doesn't break, gap theory. They're looking for the fib, guys. They know where the fib is. That's one of those patterns. My brother calls that unfinished business. We try to get to the fib. We know we want to take targets there. The buyers say, hey, maybe this is a good spot to go up. And the sellers are like, no, we need to get to 93.23. That's our goal. That's where I get paid. Or maybe the sellers took profits here. The buyers thought they had a chance. And the sellers just reloaded right here to make more money. I don't care why they did it. I can recognize the pattern. And the patterns repeat every day. Every day. We've got 30 minutes. What do you guys want to talk about? What's on your mind? What makes you happy? What makes you sad? What do you need help with? You guys know this is where I go off on tirades. The entry lesson 4. For what, Joel? For the trend trade? A lot of entries to be taken out there. Your entry is the same lesson as everybody else's. Pull back to an area inside of triggers. That doesn't change. Your lesson isn't unique for you, Joel. You might change my lesson to make it unique for you, but the best entry for a trend trade always comes from an area inside of triggers, 100%. And if you don't have that entry, what's a data dump, Alpha? When you say wish you could do a data dump, tell me what you mean. Maybe I can. Does that make sense though, Joel? This is the perfect entry. And you'll get to a point when you're solid and comfortable with the software that maybe when this isn't perfect, you'll find a way in. Alpha, I gave it to you. Everybody's got to put in their time. That's the thing. Is guys, there's no magic pills. Alpha, I always tell people, Nexgen software is the best hammer you could ever buy. But if you don't learn masonry, you're not going to do anything with it. You're just going to hit your thumb. But the fastest path. Joel, does that make sense? I don't want to be dismissive of your question. So learn the basics, learn the solid, learn the good, learn the high probability, learn the low risk, right? And then, Joel, that's when the other lessons come in. That's where you say, I know momentum, path, and entry so well that I'm comfortable that you become comfortable with the other entries. You become comfortable saying, this isn't the perfect entry, so I force a reversal bar. I missed my entry, so I take it as a little bit of a momentum trade. This was the perfect 50-50. I'll take profits at trouble and go break even. So Alpha, it's the same thing. The fastest way to get to where you want to be, and this is an absolute promise, is learn 2 very simple concepts. Learn, where's my picture? Alpha, by the end of tomorrow, get here at 9 a.m. By the end of tomorrow, you'll be able to identify momentum and you'll be able to identify a clear path, whether or not you should take the trade or whether or not you should wait. Once you have that, there's a lot of options. The first entry that I teach is the highest probability entry. And then once you get that, and let me go through my rigmarole, once you get that, I give you a plan to use those 3 rules. And this is a plan that's been proven to win more than it loses. This is a plan where I've had people get funded in those prop firms in their first 30 days. And it revolves around the idea that you don't have to know everything to be successful. But if you take the best entries, and I'm giving you management as well, and you learn how to manage them, and you stop worrying about everything that can be done, and you focus on what's easiest to do, it begins to open the doors to everyone. Better Dad, you got to stop apologizing. You didn't do anything wrong. All right, Joel. What did the triggers break? The fib, right? Dig it. What they didn't break was the divergence low. So we have a 50-50 look on a divergence low. You have no divergence. You're in on the other side of resistance inside of triggers. So, Joel, the only thing I could say is that there's a picture that shows you exactly where your limit order goes. And let me find it. Dun, dun, dun. 2 ticks below resistance, guys. 2 ticks below resistance. Because, Joel, when you have momentum and the potential for this thing to go down, very often it doesn't make it out of those triggers. Out of these triggers is where we don't want to be. So the entry was right at about 82. Your stop kept you safe, and then the market continues down. Nice trade, Joel. All right, got some catching up to do with Better Dad. And guys, if you ever have to leave the room and you're coming back, it's cool. I don't mind. I will come back to you. That was Jen's. That was Boaz. That was a lesson. That was the latest. Here we go. And then Morgan and Jen will get to you. So odds favorable momentum. There is a clear path. You're in 2 to 3 ticks below the midband. Stop keeps you safe. Everything changes. Reversal bar printed, you didn't use it. Divergence prints, it goes up, and you say, I'm still going to hope this goes down. Second divergence prints, and you're like, all right, I give up. Stop loss move to here in hope instead of following a plan to reduce risk. I agree 100%. So I think, Better Dad, the lesson here for you is that if I have a weak top, the mid band is more likely to create a bounce. That's when trends continue up from a weak top. So looking for a reason to let everything get back to good. I hope that makes sense. Nice job. Little bit of hopium on that one. Odds favorable, potential to break, perfect entry, kiss plan, boom, boom. Stop where the market shouldn't go, and then moved below the reversal bar in the direction of your trade. Absolutely outstanding. The perfect trade. Odds favorable, clear path, pulls right back to support inside of triggers. All right. This is the one that I was thinking of, Better Dad. First divergence, right? Negative number, magenta line. Second divergence, negative number, magenta line. I don't see a third divergence, Better Dad. You saw 2 divergences and price reached the third. Does that make sense? You never got a negative number. You never got another line. And sure enough, with odds favorable and a clear path, the market continued up. You never got your 3 divergences with this one. You never actually got a termination condition. Does that make sense? Where's this one? All the way over here? All right, so here's your lesson. Let me extend that line all the way across the screen. Smalls and large got above it. So with divergence, here comes the lesson. With divergence, if small and large triggers break it, then it is no longer in play. Just like fibs, just like fibs and one-to-ones. Does that make sense, Better Dad? That's it. It broke. Small and large got above it. It's broke. I like this lesson though. So I'm going to go to the client trades and I'm going to go to just patterns that repeat themselves, I guess. And I'm just going to call this one, when is divergence broken. There we go. We'll use it as a lesson somewhere else. Great job. But that's a good one. I see exactly why you did what you did there. This is one of the best things about you guys posting charts is we can get them into lessons. Yeah, it's not everybody likes this analogy. It's like finding religion, and people go so far one direction when they do, and they become hyper focused, and then eventually everything balances out and you learn how to do life with it. All right, so much wrong here. Odds favorable? Kinda. Clear path? No. Directly into a fib. Not really a bonehead move. The smalls broke, right? Why do we name trades? So, what's the name of this trade, Better Dad? Do you remember? In the KISS plan, we call this the 50-50 trade. The smalls are through, but the large are not. So one of the key things for a 50-50 trade, and it's mandatory, is odds favorable momentum. There's no separation. So there's your first red flag. And I'm going to show you why. Dun, dun, dun. These are great charts, by the way. I'm loving them. So here's what I'm going to do real quick. Well, I thought that would be bigger. Man, there we go. And then alpha, this is good for you because this kind of goes back to why we keep it so simple in the beginning. So a trade is momentum, a trade is path, and a trade is an entry area. That's exactly what we're looking for. So in this particular picture, the triggers have not broken the fib, so path is out of the equation. I don't have the clear path that I really want to have to feel like that advantage is in play. And since there's no separation between the small and large, they're outside but not spaced, I've just got momentum. I don't really have momentum. I'm making this up. And then Better Dad, one divergence can kill a 50-50 trade. Two divergences just absolutely sucks. And that divergence never broke. They're still in play. So you still have two divergences, no clear path, no odds favorable. So you're working completely off of an entry area here. Does that make sense? When you start talking to yourself in terms of advantages, it becomes evident quickly that maybe this isn't the right trade. And I know that you put so much wrong there. But I'll take y'all's and I'll turn it into, oh, why would you be upset? Did you come to the same conclusion that I came to looking at your chart? Yeah? So you're telling me, as someone that's been doing this 2 weeks, you are upset with yourself that you're not doing it perfect yet, that you're still making the occasional mistake, but you have the ability to review your charts, recognize the problem, and focus on avoiding it next time? Better Dad? It's week 3. Man, I hope you're not in charge of potty training at the house. But does that make sense if you say it like that? We love to beat the hell out of ourselves. But Better Dad, you had the ability to not only recognize the problem, to know that it was a problem, to go back and annotate it and look at it, and you know exactly what you're going to do next time. Guys, that's how you get good. So Better Dad, give yourself a break. I'm going to give you a break too. Odds favorable. Yeah, it's that strong trending. You do have a clear path though, right? That's it. Well, and if you're still making all the mistakes on sim, there's no reason to go live yet. So what kind of trade is this? You entered from the wrong side of the triggers, but you did have a clear path. The only saving grace is you managed it. Cool. So I don't disagree. So Better Dad, you had a clear path in a strong trending market. 30 bars at least in the same direction. So rule number one is a given. It's a gift in a strong trending market. You just assume that the momentum is there. And your path is clear. And your small triggers broke. And you bought the pullback to a fib. Better Dad, you took the ideal momentum trade as taught by Nexgen. The only challenge that you had with it is you held on to it way too freaking long. So here's the lesson. I love this. We may run over today. That excites me. I'm not going to lie. So if momentum is the reason for the trade, if momentum is the reason for the trade, this is why we name trades. Better Dad, does it make sense that a loss of momentum is reason enough to exit? So if I jump in because everything is screaming, in a trade like this, in a scenario like this, Better Dad, a reversal bar that closes on the wrong side of the triggers, that's your get out of the trade look, right about there. Because once this happens, you're hoping for a trend trade. But the other thing is your large chart said Better Dad get paid, and you didn't believe it. You had a beautiful target at 53, right about there. And you chose to ignore it because, once again, smoking the hopium a little bit, right? I hope it goes to the fib instead of it could stop at a 1-to-1. I love your entry, though. That's an easy $100 a contract trade. You just got a little greedy. That's it. There's a time for home runs, Better Dad. Whoops. There's a time for home runs. Hold on, where was it? Odds favorable, clear path. Shoot for the fences, right? The only thing getting you into the trade is momentum. Be willing to take the base hit. Great stuff. All right. Strong top. That's what I'm saying, since it came within 10 ticks. Since what came within 10 ticks? The triggers? Better Dad? Okay. How about termination condition with no triggers through that reverses the market? You're making something up with the distance the triggers are. I don't know where you got this. But when a termination condition, price reaches a divergence high, triggers don't break, it reverses the market, that's your strong top. It has nothing to do with these triggers. Like the distance. First it's a termination, then it reverses the market. Then it gives odds favorable momentum and a clear path. And here you decide, okay, it was so fast. 2 ticks below the midband, stop keeps you safe. First money, and then once again, break even. So, okay, so this is the Dow, Better Dad. $5 increments. I don't know the Dow that well. $5 a tick. Okay, but the patterns mimic the 8 tick, the 10 tick of crude oil. They mimic the 8 tick, 10 tick that makes sense. So the reason that it's 100 and 200 is because it's pretty easy to get 20 ticks with odds favorable momentum and a clear path. Does that make sense? It's pretty easy to get 20 ticks. That's why. Not because it's $200. So Better Dad, at $5 a tick, if you want $100 and $200, you probably need to trade a 4 lot. It's not fair to put the same expectations on the patterns from a monetary standpoint when the cash value isn't the same. If it was $1 a tick, you wouldn't hold it for 100 a ticks, right? That doesn't seem And that may be one of the challenges with the Dow, is you have to adjust your expectations. I didn't think of it until just now because I'm like, oh, that should have been a $300 trade. Why did he go break even? So thank you. You gave me something to think about here. Nicely done. But I think that's fair. So if you want to have the same money value, you're going to need 4 contracts to do it. Or chasing the ticks, you might have to be willing to cut your money in half. Great picture. Odds favorable, clear path, not perfect. Focus on the 5-1. You missed that you lost odds favorable. Mostly profit target 1 is an issue. Profit target 2 would be an area at the fib. Weak bottom. Entered 2 ticks above the 1-to-1. Can we change that verbiage better, Dad? Because the entry didn't look ideal, maybe I entered on a... You missed your entry. So entered on a confirmation bar because I was on the wrong side of triggers, and then I let it play out. I like it. Nice. Big one. Entered on confirmation is cool right there when the large chart looks like this. Hopium, though, you'll realize why that's a good trade in about 2 months. Where are we at? Right here. Odds favorable. Directly into a termination. You try to take it anyway, and it eats your lunch 100%. Broke a rule, lost some money. Did it hurt? Good. Remember that sting. We teach rule number 2 for a reason. I love it. Keep doing it. You're on simulator. Guys, if you're afraid to make mistakes on simulator, you're going to be petrified when you go live. That one didn't work. And then it turns into momentum. And you're like, well, hell, let me take the trend trade and let me refuse to get paid and give it all back. All right. Better Dad, I'm going to say you're getting tired and you're not reaching your goals and you're resetting your simulator because you're frustrated. It might be time to walk away. Why would you hold through 3 divergences and a shift change and all the way up here? There's got to be a little management in there. You're doing great. 3 divergences. It takes a while to be able to recognize it. Odds favorable, clear path, perfect entry, and this one just didn't work. Just didn't work. Testing 8 tick stop loss on the YM. It slipped you a few extra. Okay, so again, you're relating. There's just no reason to give that much up. Once you're 4 or 5 ticks below, you're where the market shouldn't go. It's not a number, guys. It's not a number. It's a location. And when you treat it as a location rather than a number, Better Dad, you realize that this is way too far outside of where you want to be. That's all the way down here. Does that make sense? You're floating in the distance. Look where your stop was. And if I showed you a picture like that and said, hey, Better Dad, do you really expect the market to continue up from here? You would say, oh my gosh, there's no way. That looks ridiculous, Mark. What were you thinking? And I'd say, well, I thought I'd give it just a little bit. That's okay. You're brand new. So we put stops. We teach you to put stops where the market shouldn't go, which is 4 or 5 ticks beyond the triggers. And this is the lesson that my brother gave me, Better Dad. And this is why you guys get the advantage of me getting the hard lessons from John Novak. And I would show him this trade and I would show him my stop. And he goes, look at where the market is. And he wasn't beating me up. He goes, would you go long here? And I go, no, look at these triggers. Look how, and he goes, okay, keep thinking about it. Keep taking these trades. But whenever you get stopped out, look at where you get stopped out. And the same was true If you get stopped out at an area inside of triggers, you go, okay, look at where you got stopped out. Do you really not want to be in a trade with this look? And I'm like, oh my gosh, that makes so much sense. And that's kind of how you grow over time. When the adrenaline of the entry doesn't become an adrenaline-fueled entry anymore, management gets easier. Everything says down, market is screaming, clear path, perfect entry. 2 divergences doesn't kill it. 3 divergences was your reason to get out. 100, break even. I don't know what this entry is. And now after 3 divergences, you're getting in again and losing money. And you're just getting excited. You're getting excited. You're trying to catch every move, right? First one didn't make it to the area. Second one was the perfect entry. And it did everything it was supposed to do until the 3rd divergence. And then it pushed to where the stop was supposed to be. Does that make sense? First one, not an entry, no areas inside. Second one was perfect, did everything it should have done. Third one was trading into the termination condition. You have to expect the higher push. I love it. I like that you know what I'm going to say. Odds favorable, directly into a termination. Take it anyway with areas on the wrong side of the triggers. Since weak, you quickly moved stop loss to break even, just waited for anything can happen triggers. Not a great entry. Set your limit on it. So, I love that. Well, that means that you're paying attention. Have you ever heard me say that triggers aren't bouncy? Triggers aren't bouncy. Triggers define where the retracement should go. Areas are what create the bounce. So relying on a trigger line to save you on an entry when the areas are up here, it rarely works. It rarely works. It's the areas inside of triggers. A lot of great stuff, Better Dad. A lot of great stuff in here. All right. Morgan, Jen, and Joe. And guys, we're going to run over a little bit today. I don't mind. Odds favorable, clear path, strong top, perfect entry, money, money. Morgan, gold star. So alpha, this is the pattern you're going to learn tomorrow. Triggers, path, entry. You're going to learn how to put it all together. Got to learn how to put it all together. And it's such a good entry. Look at this. Triggers, path, entry, money. Did it again. Hold it. Momentum, path, entry, money. 3 different people in 3 different time frames taking the exact same trade from the exact same location. Hold it. I bet it's 4. 4 different people taking the exact same trade from the exact location. And guys, that's what we do. Why did they take it? Because it's a pattern that's been proven to win more than it loses. Beautiful trading. Beautiful trading. Joel? Triggers still going up. I like to think so, Steve, but I don't care for it. All right. Joel, are you with me in here? You're so close, Joel, that I'm going to do this. Does triggers going up or down fall into the rules? Of course not. We want them strong. They can go up weak all day long. They can go down weak. We want strong triggers, right? So I'm losing my first advantage. I don't have strong triggers. I actually have weak triggers. And then I do have a clear path, and I love that. But I don't have an area inside of triggers. So not only do I not have momentum, I don't have an area inside of triggers. Joel, do you see how you're hoping the market continues up rather than your indicators telling you that it's more likely to go up? So we're just going to refine it a little bit. But Joel, check this out. See the momentum? Strong triggers, separation between the small and large. And I'm going to, guys, this is for everybody. This is a cool phenomenon that happens. This is you, right, Joel? Or is this better, Dad? No, this is you. So check it out. Odds favorable. Do you see the potential to break? Smalls are above, but large are not. It's a good look. See how it pulled back? 2 ticks above support inside of triggers? That's your trade, Joel. Because from here, it was the easiest money ever. Easiest $300 you'll ever make. Once you start giving up all of your advantages, it becomes a little more difficult. But what happens as a brand new user, and Joel, this may not happen to you, but this certainly happened to me. So right about here, I'm like, is that momentum? I think that's momentum. It looks like momentum. Hold it. Wait a minute. That is momentum. Oh, no, there's a fib. Damn it, no trade. Right, Joel? There's no trade. There's a fib. But, Joel, once the high probability becomes second nature, you'll recognize that when 50% of your triggers are above and 50% of your triggers are below, with this level of momentum, that fib has the potential to break. Does that make sense? We talk about this every day in termination conditions. It has the potential. Does okay mean yes, or does okay mean whatever? Maybe I'll pick it up tomorrow. So with the potential to break, since I don't have the clear path, I'll make sure my entry chart is pretty. What does that mean? That means strong triggers. That means no divergence. That means clearly defined entry. So Joel, this is the second trade that you're going to see on that KISS plan, and it's the 50-50 trade. So I don't know what happened up here, but I do know that this is an opportunity you'll be catching inside of the next week. But you've got to believe that there's more trades, which means that when 2/3 of your advantages are gone, you're going to develop this idea that it's okay to not take the trade and hope. Does that make sense? You're killing it though, dude. Better Dad. Odds favorable. Clear path. Pull back to support inside of triggers. First target went break even and just held that thing. And you manually closed it because of a problem. But 42,222, that's a good spot too, isn't it? Better Dad? Double terminations with weak triggers. It's all right to get paid right there. It's all right to take profits. Why? Because you're 172 pounds of awesome right here. Look at your entry. You bought the market on the low tick because it fit your rules. If you decided to exit at all the trouble, oh dude, how could you not be happy? Great trade. All right, Steve's like, Mark, let's see if you can decipher. Mini NASDAQ, mini NASDAQ, mini NASDAQ. I can't tell. 34.5. Looks like it has a lot of momentum. 55.8 is screaming down. I don't know what that is. 89 something. So, wow, Steve. Steve, have you ever looked at a calendar and said, oh shit, I have an appointment at 12:32? What month it is has nothing to do with what you have to do at noon. Man, okay. I'm not going to knock it. That's your thing. I don't know where you entered, though. Looks like somewhere around 11:56, which would be about right here. So let's do it. Odds favorable momentum. odds favorable momentum. Have absolutely no idea, but it looks like the beginning of momentum after divergence. You have the perfect pullback right to what I'm assuming is your mid-band, right at the triggers. You get in well below. And why did you exit with every chart screen? Oh, auto trade. Okay. I forget that you have the auto trades. All right, so guys, let me show you. Not everything has to look the same. This chart, this chart had odds favorable momentum. This chart had odds favorable momentum. This chart looks like it had the beginning of odds favorable momentum. And this chart had everything screaming down with momentum. Is it any wonder Steve got paid going short? I don't understand the reasons because it's something that he's creating, which I think, Steve, is pretty freaking rad that you're creating an automated system. But when every chart is gangbusters down, eventually I'll find a way to make money going down with them. That's kind of the basis of everything that we do. Thanks for sharing that. But if you go back and you pick it apart, everything says down, he went down, he made money. Nicely done, Steve. I like it when people show different charts. It's kind of fun. Odds favorable, potential to break, strong top. If it pulls back to resistance inside of triggers, I have a medium probability trend trade, and my expectation will be the fib. It may go to the fib without me. And guys, that